Good morning, everybody. Good morning. We have another good day of bears being weak and the bulls possibly taking the market. But where do we go from here, though? Like, where do we go? We hit all-time highs. We broke all-time highs. Where do we go? I know one thing. I ain't being no bull no more. I ain't gonna be no bear no more. Even though my bear instincts is like, yo, short this shit. Like, I really want to short this so bad. I want to short this so bad.
Oh shoot. That's funny.
But Like short it. Come on. Just short it.
Shoot it.
Good morning, seeing look. Good morning. Good morning. Good morning. Yeah, I saw that, man. Well, not in the Dow, but I saw that everything is green. SPY is still super green. Super green. We did have a dollar dump though. But I think today might be the day, guys. I think it might be the day. I think the Bears are finally gonna get that pullback. I think they're gonna finally get it. I mean, after
Oh
obviously
no.
after all the Bulls get, you know, out of their position. But I mean, look at that.
Yeah.
Look at all those puts that were bought at the end of the session. Look at all those puts. We might get so we got some puts that's expiring today. Oh, they sold them. I don't know. But all right, man. So this is tough right here. This is definitely tough. This is tough. Technically speaking, this is a break of structure and a retest of this. You know what I'm gonna do? I'm taking this, man. I'm gonna take it, dude. I'm gonna take it. I'm taking it. I'm taking it. No, I can't take it. I can't take it. I can't do that. That's too low. Are you in something right now, Smith? Or
Nah, I'm not.
you looking at anything to get into? Like, if you can potentially get into this move, where do you want to get in at?
I'm actually, despite everything, I'm looking for a buy,
Mm-hmm.
but I want to see if they take it to that level we was just talking about on NQ.
Oh yeah, I probably don't got no
That's
squares opinion.
level 625, 612. But
Mm.
we'll see. Hey, hold on one second.
Mm.
Yeah,
Mm. So it's obvious that at least on the NQ, I think the NQ is starting to make its rotation down. It's starting to make its rotation down on the NQ. And we may can get back down to that because that 650, 670 level. Because we had that. I mean, if we take this out, hmm, I think that might be it. I think that might be the drop on the ES. Let's see. But that's not a good place to get in. Definitely not a good place to get in this. Hmm. But the NQ is obviously rotating lower. $52.23. got 25. I mean, I don't. I mean, we got this. We got this right here. We got that. They came back in. They broke structure here. They came back and retested. So this is your break, and this is the retest. That took out that high. It looks like they're failing to rotate price higher. They broke structure, and now there's that view up. Okay, let's see what you're talking about. Yeah, that's gonna probably, yeah. That fair value gap is gonna get traded through for sure. That is definitely gonna get traded through for sure. Because I'm thinking that it's gonna at least try to retest this area right here where the 21 EMA and this prior resistance is at. So, but damn, that's all the way down there at 496. Do we see a drop like that on the NQ? This 569 seems more reasonable. That 600, it actually seems more plausible. Let's actually look at that. Let's look at that. All right, so the 4 hour, yeah. Yeah, I think this definitely is going to get traded through. Because price is currently rejecting at prior resistance. And they broke all-time highs. It looks like they came back in. They swept that liquidity. And it looks like they're going to make their move down at the bottom of this. Yeah, so that 560 to 6, I think Smith said something about 612. Yeah, I could see that. I can definitely see like a reaction in this area right here due to there being prior areas of resistance here. I can see that. That's if we get it though. He says, Joel says, but that sweep can then be now a bullish retest or go higher. Because if that high was respected, it would not be swept. At least on the NQ, from my own experience trading her, highs really don't mean nothing for real, unless it's a very strong high. And usually you can tell by it being a strong high is like once that high is made, you get price violently being pushed away from it. And as it tries to come back and retest it, it doesn't even get close to that high. But at the same time, highs are more important on the ES from what I see so far than on the NQ, because I mean, she'll run the highs about 10 points sometimes. Sometimes she'll swipe it a little bit. It really depends. It really depends on, I guess, what she's trying to do. But we'll see. I will say that it is tough being a bull this high. The risk to reward is very small up here. But I'm not going to be a bear for a while. What I plan on doing is allowing the bears to try to rotate lower and identify when and where the bulls are going to come back in. I'm going to just go back to being a perma bull because bears are weak. The only time you really get a rotation down is during just bad news after bad news. We got something coming up, something unexpected happen, and those things happen too far and in between. I think it's just better always looking for buy opportunities because especially in this market, I think the Bears will come back alive once the new president is decided. Once we get out of this election cycle, because even though the Fed is saying all that bullshit about this not being political, well, you don't get a revised CPI. You don't have a CPI saying that inflation is slightly lowering in April, and yet you go to your grocery stores and shit is still expensive as fuck. I guess your local grocery store they didn't get that memo saying, hey, inflation is slightly lowering. You can drop your prices again. They didn't get that message.
They didn't get that message at all.
They didn't get it. You got all these businesses that's about to close down. I mean, you got Starbucks struggling. Starbucks struggling. And they're their own bank now. So
Over there raising prices.
Mm-hmm.
Coffee went up. We talked about this. I said coffee inflation went up, but they wanted to take that out of the report. I was like, these people suck. They literally just changing rules to
fit their narrative. Yep.
What they wanted to say. Like, come on.
Uh-huh.
That's such a messed up thing to do, but who gonna stop them?
Nobody.
You told me they revised it so that it was better. You said they revised PPI.
Mm-hmm.
I was like, this is so crazy. No wonder why the market just straight up yesterday.
Mm-hmm. Yeah. I mean, honestly, in hindsight, I mean, this is why you kind of have to put your brain, take it out your head for a while, and just shut up in color. And just shut the fuck up in color.
That's actually a good way of putting it, because I was like, no way, I was in like disbelief. Like, what? Like, are we in the Twilight Zone right now? Like, what's going on? Oh yeah, it's definitely coming down. We're on our way to our 2% target. Yeah, by lying to everybody and making stuff up.
Mm-hmm.
Yeah, like you said, like, even though my brain yesterday was like, okay, at some point we got to short this. Nope. You just go along with it. Just go along with everything. You'd have been straight. Just go with it. No matter if it makes sense or not. Just go with it. Just shut up and
shut up in color.
Hey, sometimes that's what you gotta do, though, for real.
Yeah. I mean, yeah, we talked about this towards the end of the stream. Like, yo, it's just a straight dildo candle up, yo. It is just a straight candle up, man. Like, look at the 4 hour. Look at this, like, this is the 4 hour chart. Look at this damn thing. I just had to shut up in color, I guess.
Look at it, ate through all your ranges that you had drawn.
He said, what ranges? My grandma gave me that range. I know, right?
That is so wild.
Yeah, I know, man. The other day I was looking at my chart. I was like, yo, what the hell is all my ranges? And I was like, oh, yeah. It's like, oh, yeah.
Oh, yeah, they're down there. Let me zoom out.
Yo, I was so pissed. I was like, yo, where the fuck my ranges at, yo?
Well, at least you still got them on the ES.
That is funny, man. That is freaking funny.
Yeah. Yeah.
This is looking like a short, man. But nah. Yo, Mad Moxie came at me again yesterday, and
what'd she say?
She had me thinking last night. Well, damn. It's like, yo, can I not have a bad day? Shit. Damn. No, but I was thinking about it, man. I was thinking about it. I was definitely thinking about, dude, it's like, yo, this is the most challenging thing about this run up is that because we're not getting any pullbacks, and it's just going straight up, trying to counter trend trade this, it has been difficult. I mean, as you know, I prefer to counter trend trade. I mean, I came into this business fighting this trend always. And she asked the question, why would you trade the shorter trend or the counter trade or the counter trend versus the overall trend? And I really had to think about that. I really did thought.
Yeah.
I really did think about that. Well, if well, the main reason that I like trading the counter trend is the elevator. I like taking the elevator versus the stairs. But when we got days where the market is just grinding up in one direction, those are usually my most difficult days because obviously I like to counter trend trade, and if the market is going in one direction, well, that's going to be a red day for me most of the time.
Yeah.
And then I went a little bit deeper into it, and it just came down to FOMO, really. I mean, you missed that move up, so shit. What's the most logical thing to do? You gotta find the opposite side of the trade. You missed it. You don't want to wait for it, or you don't believe that it's going to pull back because of all the bullishness. But from what I've seen, is like, yo, if it wants to go back down and retest, it has like a flash crash, and then it's immediately bought back up. So you kind of have to be quick with it too. Oh, my bad. And then yeah, so it's FOMO, patience. I'd rather take the elevator. But I mean, if you take the overall trend, obviously you'll make the most money. It's just you gotta be patient for it. And if you miss it, well, the next best thing is the counter trend trade.
Yeah.
So I have thought about that. And then gain weight came at me too. Like, well, goddamn, gain weight, shit. We don't all got funded or personal accounts that we can swing overnight. Shit, we gotta do this intraday. So we gotta find yeah. You said what? Yeah. You gotta find opportunities intraday. Can't just hold it.
Yeah. That's too funny.
Yeah. But like I said, I do take in the criticism. I do take it in. It makes me better because once I've learned, and this was in a previous version of myself, but once I learned that the only reason why I got defensive or I didn't like what someone had to say about the shit I was doing, first of all, I don't like people telling me what to do. So that was like the main thing. But underneath all of that was either I didn't know how to do it, I didn't know how to explain it, or I didn't want to. So I didn't know how to do it. I didn't want to do it, and there was something else. But anyway, as I was thinking about it, but I realized that a lot of the stuff that and when someone says, "Hey, it'll be better if you do this versus that," initially I will fight it because that's just who the hell I am. But at the same time, once I realized I do take into consideration, and I was like, "Huh, this does work a little bit better." All right, okay.
Yeah.
I ain't gonna tell them that though. That was my initial thought. I ain't gonna tell them that. They ain't gonna win. But yeah, over time you just realize that just learning from other people, trying to take in from somebody else's experience, especially if they see the charts differently than you, it really does help improve yourself by taking in other people's opinions and or at least considering them. That's how I should say it. At least considering other people's opinions and try to see what mindset or frame of mind that they're coming from. Because I do believe Mad Moxie wants to see me be successful, so that's how I'm going to interpret her criticism. It's hey, you made a mistake here. Why did you make it? And gain weight too, and whoever. Hmm. That's why I got my boy Smith there. Sometimes he'll say, "Hey, sure, hey, you're wrong."
Yeah.
Like, oh yeah, yeah. But all right. Just went for a minute. You had Popeye's chicken. Seriously, Jonathan? For an interview at Popeye's Chicken, how did that go? He says, "Have I seen the?" Yeah, yo, credit card debt is crazy. Now, I've already explained to you guys that if you utilize your credit cards correctly, it's a great way to build your credit. It's a great way to get them free points and benefits. Honestly, my everything that I use my credit card for everything and just pay off my credit card and collect all the points. I build my credit up, I build my credit history up, and yeah, I pay my credit cards for everything. I realize that I operate in a deficit and I use my paycheck to pay off my credit cards, and it just keeps on rolling in like that. Make sure that you maintain that balance so you're not paying that interest, and it's basically free money. It's free fucking money, free money. But obviously, people don't use their credit cards responsibly. So, um, people like me or people that understand how to properly use their credit cards, the banks know that okay, we know that these people are going to take advantage of the system. However, majority of the people are going to buy some dumb shit at Ross, Marshalls, Target, Walmart, Amazon. By the time that they've used up their credit card, they hit the max, they're over the 30% utilization, and they're just going to keep hitting them with them interest rates per month. But if you properly use your credit card, it's free money. It's free money, baby. Yeah, Popeyes was actually my first job, Jonathan. That was my first job. I was in the kitchen whipping up the chicken. And all the videos that you see online about Popeyes, I don't know why it's so ghetto sometimes, or I guess it depends on which Popeyes you go to, but that shit is true. You didn't think that we was not gonna fight customers if they came in talking crazy? The whole kitchen was gonna jump that customer. And we was gonna all gonna come back in tomorrow, go back in the kitchen and continue our job. That's just how crazy it was. It's funny. It's fun to think about, but that shit is real when people joke about it online because it was true. It definitely was true. Okay. So I mean, it looks like the Bulls are trying. I don't think we got any news. I don't think we have any news that because even though this stuff kind of came in over expectation, um, the housing market came under. This came under. I guess these guys didn't get the memo that inflation is going down. Apparently, they didn't get that memo either. Um, I mean, the next thing we got is these Fed speakers speaking in at 9 o'clock. So, hmm. Oh, come on, man. Thank you. I wonder how I did. I wonder how I just did that. And then we're free and clear. I mean, once we get this Fed speaker speaking, we have nothing else today. We have nothing else that's going to be moving the market. So, And that looks like a short opportunity. Hey, Smith, are you seeing this? Does this look a short to you? That's looking like a freaking short. But all right, we got 5 minutes until this algo coming out, and we have 5 minutes until we get more Fed speakers. I mean, at this point, I'm kind of tired of playing this game, this Fed, this Fed game. Like, there's always a Fed speaker coming out. It seems every day we got a Fed speaker now. It's like, damn, would you shut the fuck up? Just say what you got to say all in one meeting and shut the fuck up. Shut up. Yeah, and it seems like, yeah, possibly like a line underneath it is it's like a good strategy. Maybe I can just 23 because that'll be, yeah, that'll be wild. At 100%, it goes to there. It's like 65%. And then it makes 100% move and then it drops. All right, so we had a bounce here, which honestly, I don't even know. Well, that happened at the end of the day. That happened at the end of the day. And then it bounced off of that. And then it came back and retested this area. Hmm. Hmm. Yeah, this is looking like excuse me. Damn it. Hmm. 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 I'm definitely conflicted about this. I'm definitely conflicted. This morning, I would have actually been in this short, actually, this morning. I would have been in this short. I had a limit here sitting at 343.50 this morning, looking at the charts. But then I moved it. I said, well, they may try to take out 45. because I saw that there was orders on the DOM at the time. There was a bunch of orders sitting at there was a lot of orders sitting here at 44.50. And I had my order all the way sitting down right here. And so when I saw that they had 44.50, because it was like I forgot how much it was at the time. It was, I think it was like 200 or 300 sitting right here. So I moved it from here to here. And when I woke up this morning, I looked at the charts and saw that it hit it to the T and saw that it dropped. And then I thought to myself, well, the news may come back up and actually fill this order. But no, it didn't. It didn't. Hmm. This is definitely a technical pattern right here. We got this retest, and then we got this break of structure. It looks like price is trying to come back into this area right here. And I wouldn't be surprised if there's bears sitting at 38 or 39. Let's actually look at that real quick. I wouldn't be surprised. Yeah, we got them sitting at 40. We got it sitting at 40. You do got some people trying to front run this, sitting at 38, at 40, at 342. So I'm guessing the market is waiting to hear what this Fed speaker has to say. In the meantime, I think it's going to be, well, damn, this might be a whole hour. This actually might be a whole hour because they usually have like 30-minute conferences. And if he's going to speak at 9 and then we got Harker speaking at 30, the market actually might be held up until these guys are done speaking. So we might get this chopped for an hour. We may get this chopped for an hour. Unless they say something outside the what's expected for the market to hear. All right, man, we just gotta be patient. So, I mean, in the meantime, we can log a new day. I will say this though. I will say this, kind of going back to what I was saying before. I will say this. Mm. It is challenging for me to say this though. It is challenging. It is. I think I believe the hardest part about writing a journal or writing in your journal is that you have to face certain demons, especially if you're going to utilize your journal correctly. My demon is I like being right. It's not necessarily a demon, but I just like being right. And because of that, when I'm wrong, I beat myself up for that a lot. and having to write in my journal, or at least tell myself that, today it didn't work out. What I thought or what I believed, what was supposed to happen, it did not happen. And I had to take a loss. That was very hard to write in my journal yesterday. I'm a very competitive person on top of that. On top of being right, I'm very competitive, which is a good thing when used positively, but can also be a double-edged sword. It does motivate me to get back in and start grinding harder. And that's the good and bad thing about losing. It's like one of those contradictions in itself. In order for us to get better, we have to lose. But you don't want to lose because it kind of shows that, or it doesn't show anything, but it makes you feel that you're a loser, which is not true. And you have to know that's not true. You have to know that every stair step to success is one failure after the other failure. Logically speaking, we all know that to be true. Emotionally speaking, we try to avoid loss at all costs, which stunts our growth.
The Committee on Banking, Housing, and Urban Affairs will come to order. We'll hear testimony today from 3 key financial regulators whose agencies are responsible for protecting our banking system and making sure it serves all Americans. The hearing comes 1 week after the release of the independent review of sexual harassment and workplace misconduct at the FDIC. A review made clear that FDIC has serious, long-running problems. For far too long, its leaders failed to take action to protect the FDIC's most valuable resource, that is, its workers. The review details episodes of harassment, discrimination, other misconduct that no one should ever have to endure, especially in the workplace, and that can never be tolerated, period. Chair Gruenberg, you owe workers at the FDIC, at this committee, and the American people clear answers and decisive action. That includes your plan for restoring the FDIC's culture and regaining the trust of your employees. The steps you'll take to put an end to workplace misconduct, harassment, and discrimination, and to ensure that victims are not silenced, and how you will ensure that
What the fuck are you talking about?
are finally held accountable. The FDIC can't fulfill its mission of maintaining stability and public confidence in the nation's financial system until the issues raised in the independent review are fixed. Failure is not an option. Chair Gruenberg, I hope you recognize this moment for what it is, a crisis. Every FDIC employee, every American deserves a workplace free of harassment and discrimination. And the public should be able to have confidence that the people at this agency can focus on their jobs. When workers face a toxic culture, it hurts the agency, it hurts its mission. Workers don't speak up when they spot problems if they're afraid of retaliation. It's not a small internal problem, it affects the public. Most Americans don't think much about the FDIC. They shouldn't have to. That's the whole point, for people to have confidence that their money is safe in the bank without having to give it any thought. And that's why the job of this agency is so crucial. The FDIC prevented the Great Recession from becoming a Great Depression after the 2008 financial crisis. The FDIC's action was crucial after the collapse of Silicon Valley Bank, and Signature Bank threatened to create a domino effect of bank failures. We need an effective, strong leader at this agency to ensure that its workers can continue to protect Americans' hard-earned money and savings. Chair Gruenberg, it's up to you to prove to the public and to your employees that you are that leader and are able to restore confidence at FDIC. The management challenges at FDIC only make it that much harder for the agency to focus on the crucial work it's doing, along with the Federal Reserve and the OCC. In the last year, since the collapse of SVB and Signature Bank, your agencies have helped make our banking system safer and more resilient. The Fed, the FDIC, and OCC issued the Basel III endgame capital proposal to protect Americans from another financial crisis. We must ensure the largest banks have enough capital to prevent another taxpayer-funded Wall Street bailout. That's what these rules do, and they make sure that banks can continue to lend to their communities in good times and in bad. The proposal recognizes the systemic importance of large banks like Silicon Valley Bank that are not as big as Wall Street mega banks, but still can do real damage to our economy when they fail. Of course, the industry and its allies on Capitol Hill have trotted out the same old, tired, and always well-funded arguments. The reality is the largest banks have been telling their shareholders and Wall Street analysts that they'll be able to handle the capital rules without a problem. They've bragged about how they've remained wildly profitable, all the while comfortably meeting the projected capital levels required under the proposed rule. This all sounds familiar. This committee hosted the CEOs from the biggest banks last fall. We've done it now 3 years in a row. Not a single CEO of the country's largest banks told us they'd be unable to meet the capital levels required under the proposal. That's why it's imperative that your agency finalize a strong capital rule that protects Americans and doesn't reward Wall Street's whining. The FDIC and OCC are also working to rein in the risky incentive-based compensation structures that have time and time again brought our banking system to the brink of collapse. Wall Street firms set up a system that rewards traders for exactly the kind of risky behavior that serves no benefit to the economy and just puts other people's money at risk. We saw it in 2008. This model essentially tanked the economy and ruined people's lives. We saw it again with the failure of SVB last year. This new rule can't go forward without the Federal Reserve joining the process. The Fed must know what's at stake. Its own report on Silicon Valley Bank noted how incentive-based compensation encouraged excessive risk-taking that eventually led to the bank's failure. Mr. Barr, I look forward to seeing the Fed join this effort as soon as possible. We've talked extensively about the importance of that. It's also why the Senate must pass our Recoup Act, which this committee passed last year. Ranking member and I and our staffs wrote it together 21-2 to ensure reckless executives who wreck their banks face real accountability. Finally, we need action to address alarming trends in the banking industry. Over the last several decades, we've lost thousands of banks while the largest ones have grown to control hundreds of billions or even now trillions in assets. A strong merger review process prevents banks from growing dangerously through acquisitions or mergers. Americans can't afford mergers that pave the way for banks to take out competitors, to close branches, to lay off employees. We've seen that in Louisiana and North Carolina and South Carolina and South Dakota. You're South Dakota, right? And in Ohio and Nevada. Wall Street bankers, the FDIC have begun to review the merger process. I expect them to take steps to fix this. Wall Street bankers crashed the economy in 2008. Americans are still paying for it more than a decade and a half later. It's why your agencies and the women and men who work there remain so important. It's vital they're able to do their jobs serving the public, free from fear of harassment, free from workplace misconduct. And ultimately, you as leaders are responsible for what happens at the agencies which you lead. I expect to hear from Chair Grunberg specifically on what you plan to do to make fundamental changes to the FDIC and its culture. Senator Scott.
Thank you, Mr. Chairman, and thank you to the witnesses for being here today. There's no greater responsibility that we have as public servants to make sure that we represent the interests of the American people and that we do it well, that we do it with character and with integrity. No greater responsibility. That responsibility starts here and now in addressing what your employees, Chairman Grunberg, describe as a hostile, abusive, and unprofessional workplace. And Chairman Brown, I think we actually need a single hearing solely focused on the concerns that the employees of the FDIC has with the leadership of Chairman Grunberg. Because the men and women of the FDIC working to safeguard our financial security deserve a healthy workplace. They deserve to be heard, to be seen. They deserve a safe and equitable workplace. But most of all, they deserve to be treated with respect. We've all seen the 200 plus pages of the special report. We all saw yesterday morning's grilling across the Capitol. And Marty, you've heard me say this to you directly. You should resign. Your employees do not have confidence in you. And this is not a single incident. This spans over a decade plus of your leadership at the FDIC. So I don't need to go into your failures and the complete lack of management while you've been at the FDIC. I want
Damn,
to
dude, it's
talk
like that?
about the people, your employees, and what they have done and what they have had to go through. How can you justify allowing supervisors to refer to disabled veterans as Captain McNasty? We're talking about a veteran who lost part of his leg in service to our country, and to work in a hostile work environment where he is referred to as Captain McNasty is just not just wrong, but disgusting. To think about the chilling reports that say employees and supervisors were permitted to mock the fact that this employee used a wheelchair. What kind of environment and culture? And how long does it have to go on before it becomes commonplace to make fun, goad veterans who serve this nation at great personal expense? Or when an employee reported that for a period of 3 years, a senior examiner would sexualize her every time he could. And he behaved similarly with other colleagues and bank employees, including asking to see photos of their daughters and whether or not those daughters were single. But it's not just your management team. You yourself set the example when you were absolutely irate and attacked your employee. Or another FDIC employee stating that they had a meeting with you and it was awful and felt very personal, that employees are made to cry as if it's some badge of honor making your employees cry. And people, after person wanting to quit. Others described your conduct as embarrassing and inappropriate. And one person said they'll likely be demoted. And if this is what it takes, they're out. One thing I learned from running my own business is that if you don't take care of your employees, they can't take care of the customer. And the customers of the FDIC, they're the American people. Mr. Grunberg, during your hearing yesterday, you stated that it doesn't matter if you believe that you can change the FDIC's culture. It matters if the employees believe that you can change the FDIC culture. They don't. Whistleblower after whistleblower, employee after employee have drawn the same conclusion. I would like to submit for the record a statement, Mr. Chairman. I'd like to submit for the record a statement from a collection of FDIC whistleblowers expressing their lack of confidence in Mr. Grunberg's ability to change the toxicity of the agency and their doubt that he is the right man for the job.
Objection.
Leadership carries with it the responsibility of stewardship.
Are we watching the right thing?
Your sheep are
Are we
lost
watching this?
and your fields riddled with weeds. In 2021, President Biden warned his staff, if you're ever working with me and I hear you treat another with disrespect, I promise I will fire you on the spot. And he did. He fired the Inspector General, Martin Dickman, of the U.S. Railroad Retirement Board for evidence that he created a toxic work environment and engaged in abusive treatment, including using crude and inappropriate language like slurs and belittling employees. I know I'm out of time. And the FDIC, in their special report, described you as harsh, aggressive, and interacting with your staff in a demeaning and inappropriate manner, having a temper and causing employees to feel disrespected, disparaged, and verbally attacked. I can only conclude with one question. What makes you so different than the Inspector General? Is it politics? Is it the fact that you are a necessary and easy vote for the Biden administration's economic policy agenda? I think the answer is yes.
Thanks, Senator Scott. Thanks for your remarks. I think we can agree that no public employee, whether in the White House or the FDIC, should ever criticize or make fun of a disabled veteran. We'll hear testimony today from the heads of 3 federal banking agencies: Michael Barr, Vice Chair for Supervision at the Board of Governors of the Federal Reserve System; Martin Gruenberg, Chair of the Federal Deposit Insurance Corporation; and Michael Hsu, Acting Controller of the Currency. Chairman Todd Harper of the National Credit Union Administration, originally intended to be here, but is unable to join us due to extenuating circumstances.
Connection lost.
I ask unanimous consent to enter Chair Harper's statement into the record without objection. Thank you. Thank you, my colleagues. Thanks for the witnesses for your service and your testimony. Vice Chair Barr, please proceed.
Chairman Brown, Ranking Member Scott, and other members of the committee, thank you for the opportunity to testify on the Federal Reserve's supervisory and regulatory activities. Accompanying my testimony is the Federal Reserve's semi-annual Supervision and Regulation Report. Today, I will discuss current conditions in the banking sector, supervisory activities, and some of our recent regulatory proposals. Overall, the banking system remains sound and resilient. Banks continue to report capital and liquidity ratios above minimum regulatory levels. Overall asset quality remains generally sound. Capital ratios increased throughout 2023, leaving the system better positioned to weather potential losses. Liquidity conditions overall are stable. Notably, liquid assets on bank balance sheets remained above their 10-year average throughout 2023. Additionally, there has been a decrease in the share of uninsured deposits in the system. However, both supervisors and banks must remain vigilant and ready for expected and unexpected stresses, as presently there are several risks we are monitoring. For example, delinquency rates are rising among certain commercial real estate loans, such as those backed by offices, and some consumer loan sectors. CRE delinquencies are now at a 5-year high. Credit card and auto loan delinquencies have been rising. In response to rising delinquencies, banks have increased loan loss provisions. On this basis, combined with their capital positions, the banking sector as a whole should be prepared to absorb loan losses that may materialize and continue fulfilling its vital role, providing credit to households and businesses. The Federal Reserve continues to monitor these conditions carefully. It has been a little over a year since the sudden failure of SVB and ensuing stress in the banking system, events that highlighted the need to improve the speed, force, and agility of supervision to better align with the risks, size, and complexity of supervised banks as appropriate. We have been making progress on these goals. First, we are working to ensure supervision intensifies at the right pace as a bank grows in size and complexity. Second, we are modifying supervisory processes so that once issues are identified, they are addressed quickly by both banks and supervisors. Third, we are finding ways to better incorporate forward-looking risk analysis into supervision. The lessons learned from SVB are not only applicable to our supervisory framework. Certain aspects of the failure show that enhancements to our regulatory framework would benefit the safety and soundness of our banking system. One of these enhancements was already in process several months before SVB's failure through an advance notice of proposed rulemaking, expanding the application of long-term debt requirements to additional large banks. Subsequently, the board, the FDIC, and the OCC followed up with a proposed rule that would increase the options available within the resolution process and enhance financial stability. We are going through comments now that we received on this proposal carefully. Another important area is liquidity risk management. A striking feature of last year's bank stress was that SVB, Signature, and First Republic struggled to cope with unprecedented deposit outflows. Banks found it difficult to monetize their held-to-maturity securities through repo transactions under severe stress, and were not adequately prepared to utilize the Federal Reserve's discount window. We are exploring targeted adjustments to our regulatory framework that would address each of these concerns. The Federal Reserve's lending to banks through the discount window plays an important role in supporting the liquidity and stability of the banking system and the effective implementation of We are reaching out to a wide range of depository institutions of all sizes.
You're not missing nothing.
To learn from
we
their
just had this
experiences
pump.
with the discount window in order to improve our operations. Turning to capital,
I'm beating myself up. Not beating myself up, but I'm thinking to myself, how the fuck did I miss this double bottom here? Like, how did I miss it? Well, I was looking at the NQ though, but
a well-capitalized banking system reduces the probability
because I was looking at the ES
conditions
and I was actually thinking about taking this trade right here, but I was like,
economic
I kind of want to get in right here
for families and businesses
because we got the 200 EMA right here.
Since my last testimony, we received numerous
I have this level on my chart
on our capital proposal. We also received
So
additional
I was like,
data.
let's see what happens.
Analyzing this
But
information
I did look at getting in here
we'll
because
have
of
a
this
set of broad material changes to the proposal
right
that
here.
allow us to have
But man,
a broad
that's
consensus in moving the proposal forward.
yeah, dude.
The changes
Okay.
will enable us to have a safer financial system that better serves American households and businesses. Thank you.
Thank you, Mr. Barr. Mr. Grunberg, welcome. Proceed, please.
Thank you, Mr. Chairman. Chairman Brown, Ranking
So
Member Scott,
currently
and
we're
members
watching
of the
this thing with
committee.
the
Thank you for
like,
the
dude, I have no clue what the
opportunity
hell they're talking about. They're talking
to
about
appear before
harassment
you
in the
today.
workplace.
I'd like to
Like,
focus my remarks
what the fuck
on
does that have to do with the money
FDIC's
that we're trying to make in the
ongoing
market? Like,
efforts
what the fuck?
to transform its workplace culture. Let me begin by saying that I am deeply committed to the
I mean, that's
FDIC
an
and its
HR meeting.
mission,
Like, nobody cares
as
about
well
that
as to the
shit. That's an
people
HR meeting.
on whom that mission depends. That's why when news
What the fuck
reports,
is he talking about?
sexual harassment, discrimination, and other misconduct surfaced last year, it was essential to gain a deeper understanding of the agency's
Yeah, these guys
workplace
live in a
culture.
fairy tale world. It's just like
My
they all talking
direction,
about this
The
and that.
FDIC initiated
And
an independent third-party review to determine the
what I
depth
do agree
and
with,
extent of
if
these
people don't
issues.
respect him as a leader, then
Last
he doesn't need to
week,
be there.
The results of that review,
But if
which
they're
was
talking about
conducted by
workplace
the law firm of
harassment,
Cleary Gottlieb,
that should be an
were
HR meeting.
released. The review found that for an extended period of time, the FDIC has failed to provide a workplace safe from sexual harassment,
Oh my God, dude.
discrimination,
I
and
want to
other
turn this off,
personal
but
misconduct.
I mean, it's important to listen to this
accept
crap, but I want
the
to turn it
findings
off.
of the report, and as chairman, I take full responsibility.
Who's that?
So this
anyone
is, so I
who
think
has
this is the guy,
experienced sexual
he's like the
harassment,
vice chair
discrimination,
of the
or other misconduct
FDIC,
at
which
the
is basically what your
FDIC.
bank account is
I
insured
again
with.
want to
So what these people do
apologize and
is
express how deeply
they
sorry
insure, I think,
am.
up to like 100K
I also
of your bank
acknowledge
account.
my own failures as chairman,
So it's like an
both in
insurance company
failing
for your
to
bank account, and
recognize
this is why these
how
banks can come
my
out and say that,
temperamental
hey,
meetings
we
impacted
can
others,
guarantee up
and
to
for
at least
not
100K
having
or whatever
identified
agreed of your
deeper
account
cultural
if something were
issues
to happen.
at the FDIC.
So it's like insurance for your bank
sooner.
account, basically.
I am personally committed to addressing these issues. We accept all
But I'm
recommendations of this
Yeah,
report
they're like a subsidiary of the
and are
Fed, I think,
incorporating
if I'm
them
not
into our
mistaken.
existing action plan
This-
for a safe, fair, and inclusive work environment. To restore credibility with our workforce, we must act swiftly on the report's recommendations and demonstrate a
He
commitment.
says, so Joel says,
to
can
making
Bitcoin go to
fundamental
63.5
change.
and I get loan?
For this reason, we have
We'll look at
already
Bitcoin in a
begun
minute.
implementing several key recommendations of the report. The report recommends that we identify and appoint a transformation monitor who will monitor, audit, and report on our implementation of the recommendations. We have already begun that process and will issue a
All right,
request
so
for
the
proposals.
FDIC is a government
as
agency
early as
that keeps
this
your
week.
money safe in case your
The
bank
report
fails.
also recommends that
It
we
insures
engage an
deposits up to
independent third-party
250K, so
expert to support our efforts.
250K, not 100K
We
per
have begun
person
that
per bank.
process and
This
will
insurance
also
gives people
issue a
confidence
request
in the
for
banking system.
proposals as early as this week.
Just print more money.
I mean, that's how they do it. They print money. That's how they insure your bank, is they print money. The central bank, the
receiving
Fed.
and investigating
So,
complaints and taking disciplinary action against misconduct in light of the failure of the existing offices delegated those duties. We will do this by proposing the establishment of an independent Office of Professional Conduct, which will report directly to the FDIC Board of Directors. It will be charged with fulfilling these responsibilities, including through the use of outside
so Joe, I don't trade. I don't trade Forex.
The transformation monitor and independent third-party
Bitcoin
expert
futures. I think
will
actually,
advise
I
us
think
on
Top
this
Step has
proposal.
Bitcoin futures, if I'm not mistaken. Let's look.
Since December of last
They
year,
got
the
Bitcoin
FDIC
futures.
has been focused on implementing
They got
its
micro
action plan
Bitcoin, yeah.
to address all aspects of the issues raised
got
in the news
micro
reports
Bitcoin.
last year. The plan represents an
Huh.
agency-wide
Yo, you know they got
effort.
micro Bitcoin on Top Step
Many of
X?
the recommendations outlined in the
I
report
did not know that.
recently received
Yo, let's
are
actually take
already
a trade on this,
encompassed
yo. Let's
in
take a
the
trade. I want to see how this
agency's
shit.
action plan.
I want to see.
The plan is focused around three core elements.
Yo, we might be trading
Providing
Bitcoin on
more
this channel now
support and
too, yo. We might be
resources
trading
to
Bitcoin.
victims,
Hey,
strengthening
yo,
the
thanks for that,
process for
Joe. I didn't even know they
reporting
did.
and
Well, I mean, I knew it. I just never
investigating
considered it.
and improving accountability for anyone who is found to engage in misconduct, including through separation from the agency.
What's the
To establish an independent
It's a
Office of
MDT.
Professional Conduct
I'm about
would
to find out right now.
advance all of these goals. It is my privilege to lead and
Find out
work
right now.
alongside everyone at the FDIC. Our people are
I guess apparently
extraordinarily
it's not that liquid
dedicated
because I haven't gotten
to
filled.
the agency and its mission. They deserve to have a workplace where all feel safe,
Order filled.
valued, and
All
respected.
right, so let's see.
There is no higher priority
So I'm
than
in this.
delivering on that commitment. Thank you.
Thank you, Mr. Grunberg. Mr. Su, welcome.
Thank you, Chairman Brown. Chairman Brown, Ranking Member Scott, and members of the committee. I'm pleased to appear today to provide an update on the activities and priorities of the OCC. The overall condition of the federal banking system is sound. OCC supervised banks in aggregate continue to have strong levels of regulatory capital and sufficient liquidity buffers, though risks from commercial real estate and interest rate exposure continue to warrant attention. Banks and supervisors need to remain on guard against complacency, one of my top priorities for the agency.
your Bitcoin order got
The Bank Supervision Operating
Yeah,
Plan
it's
for
50 cents per
2024
point.
highlights asset liability management,
50 cents per point.
allowance
It's
for credit
50
losses,
cents per point.
cybersecurity, operational risk, and consumer compliance risk as our key areas of focus.
I don't know about that, dude.
Wow.
Another priority for the
How
OCC
many
is
contracts
promoting
you put on?
fairness
Just
in
one?
banking.
Just one.
This April marked the one-year anniversary of OCC guidance to assist banks
It's
in
50
managing
cents per
risks
point.
associated with overdraft protection programs. Since the OCC's heightened attention on overdrafts began,
I don't
the
know about
overdraft
that.
fees charged by
I wish I knew about that earlier.
banks in aggregate have fallen 40%. Adapting to digitalization has been a third priority for the agency. We recognize, for instance, that community banks may
Actually,
face
let's see.
hurdles in
Let's see
risk
if they got
managing
it.
their third-party
Because
relationships,
what's that dude's
including
name?
with fintechs. Earlier this month, the OCC,
He's made this very
Federal
popular.
Reserve, and FDIC
I want to see how much
published
this
a
is per
third-party
point.
risk
All right,
management
I guess we can
guide
ask
for community
ChatGPT.
banks with examples of innovative approaches to conducting due diligence and assessing new fintech companies. The OCC supports a diverse and dynamic banking system and continues its focus on updating our bank merger analytical frameworks. We remain committed to working with our interagency peers, including the Department of Justice, on this effort. To increase transparency, on January 29th, we released for comment a proposed policy statement on bank mergers. We recently extended the comment period to June 15th. My written testimony provides greater detail on these and other activities of the OCC. As co-chair of the FDIC's Special Review Committee, I would like to address briefly the recently released independent report on harassment and misconduct at the FDIC. The top priority for us all must be protecting the staff of the FDIC.
I guess this is not liquid either.
The
because I'm not
harassment and
getting filled.
misconduct detailed in the report are totally unacceptable.
The number and scope of
Order,
allegations, the patterns of misconduct, and the long-standing culture revealed by the are highly disturbing
All right,
and
so
need to be fixed immediately.
this must be like
The root
$5 or
causes and
something.
recommendations cited in the report
This must be
provide a
$5.
clear roadmap for what needs to be done and why. That is where our attention must be focused.
Because in order to
ensure
lose
the
500
FDIC
bucks,
is a safe workplace for all of its employees.
I would have to be wrong
As a member of
110
the
points
FDIC board,
to
I am
lose
committed to the
$500. Yo,
transformation
this is,
called for in the report.
huh?
I am especially
Does
supportive
it
of
move
the
up like
report's
that?
recommendation to engage an external expert and establish an independent monitor to ensure that the agency's efforts are tracked and that accountability is enforced. I also believe that Chairman Grunberg
okay.
has accepted
Yeah.
responsibility for his and the FDIC's past failings.
Oh, it's $50. Hold
To
on.
lead
Is it
the
$50
agency
per
in taking
point?
the actions
$100 per
necessary
point?
to make it a safe place for everyone to work. Thank you. I'll be happy to answer any questions.
It's $25 per point. This is the NQ plus 5.
Chair Grunberg, you offered
Or
an
no,
action
it's
plan
not.
last
I think
year
it's
to fix
$5
the
per point.
agency,
Never
but
mind. I take
last
that back.
week's
It's
report
$5 per
made
point.
clear much more is needed. One particularly concerning item is the third-party report that some employees don't believe that last year's action plan will bring about real results.
Order filled.
They said, quote, they reported experiencing or observing interpersonal misconduct by a number of the managers currently participating in the action plan. Pretty egregious statement. Yes or no? Can you commit to us today to review any accusations of misconduct against the managers charged with developing the action plan, and take strong, appropriate action to hold them accountable?
Yes, Mr. Chairman.
Okay, thank you. What do you say to the employees who, understandably, considering the years of history, this agency, what do you say to the employees who don't trust the steps you're taking to reform the agency?
Mr. Chairman, we are committed to implementing the recommendations of the new report and to making fundamental structural change in the way misconduct is addressed at the FDIC. Most fundamentally, I think this gets to the core of the issues raised, we have to cut the good old boys network that is serving as an impediment to employees coming forward and reporting experiences of abusive treatment. And we can do that by establishing a new independent office at the FDIC outside of the existing organizational structure, accountable directly to the board, that would assume all of the responsibilities for dealing with misconduct at the FDIC. That would include
Yeah, okay.
receiving
I see what happens. So we got
complaints
that
from
broken
employees,
structure. It did come back
providing
in,
employees
they
the
sold it,
support
and then they
and
bought that shit right
protection
back up.
and assurance against any concerns about retaliation that is necessary for employees to come forward. It would assure independent investigations of complaints by outside third parties. And it would impose a strengthened disciplinary process that would be swift and sure and transparent and have only one focus: justice for the victim. And if we can do, when we do, those three things, that will make a dramatic impact on how these matters are handled at the FDIC. We have, as the report notes, existing offices with those responsibilities. Those offices have failed. And we need to move to a new office outside of the existing structure that will provide the kind of independence and assurance that our employees need to hold individuals accountable for misconduct that may occur.
Understanding your credibility starts by ensuring that managers
All right, man.
accused of wrongdoing are not allowed
Yeah,
to
I'm
police their own behavior.
I'm
It
not gonna
starts
listen to
with
this
that.
shit no
You
more.
understand?
And they ain't talking about shit. I'm not listening to them no more. They ain't talking. Okay. They're not talking about anything. Okay, so Joel, kind of going back to what you were saying. I think that might, well, I mean, I would never tell nobody how to trade. I think that I would just be prepared to scale into this. I'll be prepared to scale into that. If price does get back down to this 63,500 level, honestly, I wouldn't even feel comfortable. I would, me personally, if I was trading this. Yeah, I'll try to get in around 62,700, 6260. And the reason why I would try to get in right here is because you got this breaker structure right here. And then you can see that they came right back in right at that same level and knocked it down at a retest. So they broke the structure. They had a breakout at this level. They broke at this level again, and then they retested the same level and they pushed it right back down. And then once price got back up to it, you can see the breakout at this level. So there's a lot of activity here at this level, at this 62,700, just to round that shit off. 62,700. If I was trading Bitcoin, that's what I would wait for a dip buy there. If I'm going to buy, I'm buying there. That's too easy. That's too easy right there. That is too freaking easy. That 63,500 buy would definitely be too easy. And if everybody is getting right there, that would be a nice stop run down. That would be a nice stop run down right back into that area. So you trade how you want to trade, but if I'm trading it, I'm getting in at that 62,700 level. But all right, man. But Smith, did you? Oh yeah, you said you left the charts. But man, man,
Did you take anything?
no, I did not. I was actually looking at this level. Originally, I was looking to get in around, actually not 328, but around that 325 level actually. Because at least on the ES, and this is what I was looking at initially, but I guess this is another instance where you just might as well just shut the hell up in color, I guess. Hold on, let me put this back up real quick. Because I mean, we have this range. This is a balanced area. We have the bears trying to sell it. They came back in and sold it, trying to push price again. We got the support area right here. And obviously the bulls came back in and then they're pushing it up. What I think is going to happen, and this is actually what I'm going to be looking out for. I think we're going to get a stop run. But I'm going to be looking for this 45, 44 level for the bears to come in and possibly push this price lower.
You see if those.
You said what?
They're still sitting there at 750 on AQ.
Yeah.
750, 737.
I mean, I see a whole bunch of orders sitting at 53.62 on the ES, which is at the. I can see why people have their orders sitting there at 53.62. I have that as a level on my chart as well. I have that exactly as a level on my chart. Yeah. And it has like about 566 orders sitting there at the on Bookmap.
Yeah, I think these orders about to get ran.
Yeah. Yeah. Oops. On the wrong chart. And you said that 50 level? Yeah. But we all know that 45 is going to actually be that level. You know, it front runs that shit.
Yeah. Yeah, you got a front run for sure. Yeah, I wasn't even. That's why I got my order at 45. That's so funny. Yeah, that's so funny. 'Cause I looked at it, I was like, let me move this down 5 points. It may get to like 48, 49 or whatever, but to be safe, let me move it down 5 points. That's sad.
Mhm.
You've been doing that on lately. So you think you've been doing that on all these like key levels of interest. You've just been front running, and then eventually later on it'll hit. Front running like a mug.
Said gold. So I officially hung it up. I officially hung up CL yesterday. I ain't trading her for a while. I am not trading her for a while. I didn't lose no money on her, but she just moves too damn slow for me now. Like I don't. I'm just not in tune with CL anymore.
Really?
I'm just not in tune with her. I put on a trade and I walked back and I was in that trade for about a couple of hours and I came back and that shit only went up 20 cents. I was like, dude, I can't do this. I can't do this. I can't do it. I can't do this.
I understand for sure.
Yeah. So you said on gold. Gold. So the price is definitely trending down. Gold is almost similar to CL in how it moves. Gold moves just as slow as CL. And you only get those pops when the dollar is going up and down, obviously. So we got this area of support or resistance turned to support on gold. We can see that the bulls did try to come in. We do have this area right here, the 200 EMA right here, that's holding price up currently. With gold, you kind of have to wait. You kind of have to wait for a retest. You kind of have to wait for that confirmation move that with gold because of how slow it moves. Because you can get in right here. And I know these people who's been in this move. If you're trying to counter trend trade gold right now, yeah, this is tragic. This is torture. Just being in a position for hours just for it to not even move. That's torture. But we are getting this stair step down. You can see that the bulls are trying to buy this up. You can see that they are trying to buy it on his way down. All right, so we got this break. They came back. They ran the stops. They started to trend. This is a great area for the bulls to come in, if they're going to come in. This is a good area, but honestly, I wouldn't buy it as it's trending down. Not gold, not gold, not CL. They move too slow for that shit. You don't even know. Like you get in, you be like, damn, how far can this shit go? Because it's just inches. It's just inches until it doesn't. You know, and this is a great area to go long. You have this consolidation right here. You got this breakout. You got to pull back into a support area. And that's why you got that massive move up. Got that massive move up after they came back in and tapped into this liquidity area. And when I see a move like this, Yeah, I wouldn't be surprised. I'm actually going to write this down. This is a good area for the bulls to come back in. Where price is right now. We might get a stop run somewhere in this area right here. If the bulls don't hold this up, well, we can definitely get a move down lower. All right. Nice. Hmm. I am looking at this on the ES. I am contemplating if I should. Oh, okay, there it goes. There goes that stop run. There goes the stop run. Should I take this? Should I take this? I I want to take. I'm gonna take this. I'm taking it. I'm taking this. I'm taking this. But I kind of wanted at my. Damn it! No, damn it! 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 Think I should take this. Think I should. Think I should take that. You got a bunch of orders sitting at 47. Oh. You know what? I'm gonna take this. I'm taking this.
What you trying to do?
Hmm. This is tough. So let me look at the NQ real quick. So I have my short limit sitting here this morning at 44.50. I'm gonna take it. I'm gonna take it. I'm taking it.
Order filled.
I'm gonna take it. I'm taking it. I'm gonna take it. Okay.
Taking the short?
Yeah, I took it short. I took it short.
I understand why, but I don't know.
Yeah. 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 Yeah.
Yeah. Yeah. I understand why you took it, but at least for the NQ standards, I feel like they want to take it a little bit higher and then potentially dump it or, run all-time highs. Just those things.
Not gonna lie, man. This is definitely challenging. This is a pristine setup right here. But uh,
Yeah.
this is a pristine setup. Of course. All right. The real question is, should have waited for this entry? Oh, there it goes. Yeah. All right. So that 45.50 level got hit. That's where I had my limit sitting at this morning, thinking that it wouldn't get hit today. Let's see.
Right. We should complete for that.
Yeah, I'm not going to risk that much on this trade. I'm not going to risk that much.
I feel ashamed. I picked up some Apex accounts because they're so cheap.
Dude, I was fighting myself about that all last night, man. The 250Ks are like $18 right now. And I was fighting myself, dude. Oh, man, I'm fighting myself.
I had to do it. I mean, yeah, I had to do it. But I bought some 50Ks though, just because of the easier target, I guess.
Yeah.
They're so cheap. So I was like, I just passed 3 of them, but
Oh, did you?
I was waiting on not all of them. I picked up 5 of them, but not all of them activated at the same time, which is lame. So I couldn't trade them all at once. So I got 2 more to trade. I'll probably look for a setup. I was pulled away from the market and missed majority of that pump. And that was a good, like you said, a good double bottom on NQ.
Yeah, I hate the fact that I missed that, man. I hate the fact that I missed that.
Yeah, I caught half of it, but I caught the slower half, which is right now the second half of the pump. So yeah, I gotta do 2 more. Which now I'm thinking in Q they're gonna try to keep going for that level, at least make people think they're going for that. Yeah, that 750 is still all of the orders still sitting there. We'll see. Close. Imagine if it runs up and then just boom, reverse.
Yeah.
Like 200. That would be crazy.
Yeah, I'm looking at the NQ right now. I wouldn't be surprised. I wouldn't be surprised. I would not be surprised. Yeah, if it stops right here, I wouldn't be surprised. Yeah. Oh well.
Move my orders and stuff around. My 45. I took it off. I just closed everything.
Yeah.
But I was longing around 715, 720, kind of scaling in. Oh, there it goes. There she goes. Looking for that elusive 750. We going for gain weights target. He want a 19K NQ. 20K.
Man. Okay.
49.75. 49.75. Yeah, today is a shut up and color day. Just go with it. Don't try to fight it.
That's hard to do. That is hard to do,
49
dude. That is so hard to do. That is so hard to do.
It holds off 750 and misses it by a tick. That would be so diabolical. Everybody expecting to run 750 and it just drops from here. Remember that happened to us. We were looking for some level. I think it was like 400.
Mm-hmm.
Something 400. Not even like 16,400 or something like that. And it stopped short of it and just dropped. Everybody and their mom had positions ready to exit out right at 400. So there it goes. There she goes.
Okay.
Just swap 750.
All right. Yeah, I'm done, man. I can't deal with this anymore. I'm just gonna start waiting for pullbacks now. I can't deal with this shit. I can't deal with it. And these bears are just so weak. I can't deal with this no more, man.
You said you weren't gonna be a bear anymore.
Dude, that's what I'm saying, but my mind is like, dude, that is a freaking short setup right there. Take that shit.
Yeah.
Oh my God.
No, that's why I said I understood where you were coming from. Why I understood why you took it, but I've been burnt too many times by that lately, and I just shut up and colored. I just went with it. I'm like, because things are just not making sense. It's irrational right now. Well, whatever, just go with it. Like, look at this chart. It's just straight.
Yeah.
Dang, let me look at everything else. Like, SPY is probably sitting.
Yeah, let me look at this real quick because I just saw something. Wow, okay, nice. All right.
NVIDIA 954, 55. Tesla back up. Bro. Can you imagine buying those leaps that when Tesla was at 140, 150?
Sometimes, I mean, I just hate the fact that I kind of learned how the market worked kind of late in the game because, man, opportunities like that only come once in a life. Well, not once in a lifetime, but it comes too far in between of each other. And yeah, that would have been nice.
Well, I mean, y'all know my story. How I effed up my bag on GME.
Oh yeah, we were just talking about that yesterday.
Oh, were y'all?
Uh-huh.
I bought GameStop when it was like $8 or $9, bro. $8 or $9. I picked up a couple hundred shares. And me thinking I'm like,
Warren Buffett.
it got up to 26, somewhere around there. And then at 629, then it started kind of acting up. I was like, you know what? I'm gonna just sell and take my profits. Little did I know that was the investment opportunity of a once in a generation. It was a generational play, and I blew back early by selling out. I should have stacked up on options and all of that. If I had known, I didn't know the movement was going to be that strong.
Yeah.
So I think it got up to what was I don't remember what the official high was. It was 3-something, but I know after hours or pre-market, it got up to like 430 or something like that. I was like, damn. Oh, I was feeling so bad.
So it says that the stock reached an all-time high of $483.
483?
Yeah,
damn.
you bought it at $9. You had 100 shares.
I only spent like $800 or $900 shares, and yeah, I blew it. I blew it. Opportunity of a freaking lifetime.
Did you ever do the math on if you were to hold it to its apex? Damn, that's 50.
Nah, I didn't want to do that.
Want to do
I
that to
didn't want to
yourself?
upset myself even. I didn't want to upset myself even more. I'm like, where's that bridge at? Let me go find it and
Jump
nah.
off it. Oh yeah, there's no structure to the side. I scroll to the left, saying that there is a structure at.
But yeah, I was definitely sad about that. Then my short play on Carnival Cruise Line,
Mm-hmm.
I saw that too early as well.
That is crazy. 349. You know what? We'll see. I mean, I might have to break even on this trade, actually. I may have to break even on this trade. You know what? This is that 2021 bull run, man. This is that 2021 bull run where it just irrationally just continues to go up for no reason. Did we get a stimulus check?
Yeah.
Did we get one?
I'm trying to see, was there any news or something that came out affected this? Because this is, yeah, it's wild.
Mm-hmm. Yeah, I'm probably gonna have to break even on this trade. The way it's looking, because the bulls may come back in. I mean, unless the bears just crash this thing down, and hopefully they do that. But you know, these bears so damn weak. I don't know, man.
Yeah.
Yeah, they may come back in at this top. So yeah, I might have to break even. I might have to break even. But I'm gonna hate it if it continues down. I'm gonna hate it. So 383. Yeah, I think yeah. I might. Yeah, we might get that. Yeah, we might get this first target. Put it up at 39. Yeah, we might get this first target. Because it's, I mean, even if the bulls do kind of try to buy back in here, I think there'll be more bulls right here at VWAP and stuff like that. So I think we can at least get the first target, depending on how, if the bears can begin to try to rotate this lower, we can get this first target, possibly the second target. Oh yeah, so for those, so I now I understand what everybody was talking about with Apex yesterday. So Apex is just enforcing old rules that they've already had in place. It's just that they weren't enforcing them apparently. And so the strategy that I use, almost, I don't use it all the time, but from my current understanding, it's like they don't want you to scale into your losers at all, which that doesn't make sense. They don't want you to dollar cost average into your losers. So let's just say that if this was a losing position, and as it goes down, or kind of like what I'm doing right now, I set my initial limit right here, and then I had another one right here. Apparently, Apex doesn't want you doing that. And using your account balance as your stop loss. I mean, y'all got a trailing drawdown. I mean, what else can you do?
Yeah. That is true. I'll be back though. I'm gonna go grab some food.
All right, bro. Yeah, Smith, you sound kind of tired, man. You took
Man, I am exhausted out here. I'm so ready to go.
you're ready to come back.
I'm over it.
Yeah.
It usually gets. Yeah.
Yeah. Mhm.
But yeah, I'll be back. Look at the charts.
But yeah, so I mean, I did go into the Apex Discord and people were kind of, what's the word I'm looking for? Spazzing out. And I'm thinking to myself, it's like, well, I mean, maybe everybody's looking at this in the wrong way. Either if Apex is making $1 million payouts and y'all want to continue to get those payouts, and we all know if somebody is changing something, that means that something is going to break. That's why it's being changed. I think if Apex is changing its rules because it's losing too much money, I think this rule change is beneficial, especially for Apex traders, unless they're at least they're getting in front of something that could potentially break their business. Because I mean, shit, they're paying out these $1 million payouts, and I don't think anybody wants to pay anybody or wants to ever have millions of dollars going out of the company. I think everybody would prefer for millions of dollars to go into the company, but the legalese that they're using is saying that they don't want people to YOLO into a payout. But the way that they got their thing structured, I mean, shit, how can you really YOLO and survive? I mean, once you hit that that limit, I guess you do have all that drawdown, and I guess people do kind of use that as their stop loss. But shit, we deserve that. We got through all that bullshit ass rules. So I mean, I can see both sides. I can see both sides. But that's the new rule that Apex has come out with. Now they're trying to enforce it, or they're not trying to. They say that they will enforce it. How they're going to enforce it, I mean, who knows? I don't know if they're going to have stuff to where, because I mean, I don't think it's realistic for them to be able to review everybody's accounts that ask for a payout and see if they followed that rule. What I think they're probably going to do, though, for the bigger payouts, I think that might be for the bigger payouts, the ones that are like 50K or however much. They're going to probably review those payouts, not the $2,000, not the $500 payouts. No one cares about that. That's a small payout on a scale of bigger ones. But I do think that they'll look at the bigger payouts and see if this person is like, let's see if he did this, let's see if he did that, et cetera, et cetera. So I think that's how they're going to move forward with that. You said Nate Bear. Who's Nate Bear? Who's that? Says I bet 19K. I mean, if the market is trying to get to that 19K profit target. Oh, contact ads. Oh. All right, let's see. Let's see if this, because actually, you know what this might actually be? Okay, yeah. Okay, we can get this first target hit. You can get the first target hit for sure. Come on, dude. Come on, just hit the first target though. I think this actually might be a head and shoulders pattern about to form up. I think this might be a head and shoulders pattern. I think we might get a dip. So if I'm correct, this might be a head and shoulders pattern. We might get the first target hit, possibly the second. I think the bull's going to come back in right here, and then they're going to probably knock it down. And this is why I like the counter trend trade. You see how it just goes straight down? I mean, if you can get in at the right spot, you can get the straight move down. And that's the biggest thing why I like counter trend trading. But at the same time, because you're trading counter trend, you don't know exactly where they'll come in at, and it'll be violent. Girl, damn it, girl, just hit it. Shit. Stop playing around with it. All right. Yeah, there we go, baby. Shit. Do it.
Order filled.
First order hit, baby. First order hit. We got our first target hit. We're going to go for that second target. But the bulls actually might come in this. You said, why did I kill your lungs? Oh, your lungs. I ain't do that. Yeah, they actually might come back in right here. Or at least they're going to attempt to try. This is a great area for, you see this run up right here, but I think this might have been a stop run higher. I think this actually might have been a stop run higher. Are we going back to regular price action? Can we get regular price action back and not this crazy ass bull trend up? Don't make no damn logical sense. I say your TP's at 750. Yeah. Yeah, that was actually a great area to get short. That 750 level is a great area to get short. I think the market is just tired of this crazy pump, man. It's just, come on, just pull back. Just have regular price action. Damn. That's crazy, man. Stick into the code. All right, I can feel confident in my shorts now. I can kind of feel confident now. I can kind of feel confident. I think we can at least get a decent pullback. It's gonna be tough. It's gonna be tough. But I think we can get a decent pullback, and this can be the start of that rundown. I don't know. All right, so I scaled into the 47, scaled in at 47. We got a value area. We got the value area high at 34. So I'm gonna put this at 35, 34. Okay. All right, so let's see if something was said, or let's see. Let's see. Yeah, that's crazy. So basically, that whole meeting was them talking about whatever the hell they was talking about in the workplace, which honestly, I have no clue why they felt the need to actually have that broadcast. Like, I have no clue why they felt the need to do that. That was absolutely a waste of time. Apparently, he said that CPI is still not where the Fed is trying to get at 907, but I completely missed that. When did he say that? I did not hear that. But I guess he must have said all that under all that bull crap they was talking about. That could have been done in private. Says the BE to cut the bank rate by. So obviously the Bank of England is set to cut 25 basis points in August. Oh, okay. So I guess that's what the consensus is. Hold on. So it said 38 of 71 economists. Okay, that's what the consensus is. That's what they're trying to forecast, is that will. Yo, apparently Barkin said all this crap, but shit, if anybody heard it, I don't know. So NYA, man, I'm not gonna say your name, but he's Smith is overseas right now, and unfortunately his internet connection is not stable out there. Unfortunately, it works when it wants to work, and when it wants to work, it's choppy at best sometimes. When he first got there, it was stable enough, but I guess that was the universe getting them comfortable before they hit him with reality, I guess. So unfortunately, that's the situation that he's in right now. So we just have to deal with this just for a little while longer. Honestly, it sucks. It just seems like every step of the way, every step of once what me and Smith is trying to do goes to the next step, is always something else. When we first started out, we had great momentum, great growth, and unfortunately, as we were moving on to the next step, it just seems like it was either technical issues. We had to change up the whole setup, technical issues. It was this, it was that. But y'all guys get to benefit from it. Y'all guys benefit from it. Y'all get to watch high quality trading for free. I promise you, there's nobody else doing on YouTube what we do. I mean, if you would prefer scalps, then I think everybody's doing that. But real trading, levels, this, that, nobody else is doing that. Not that I've seen, not free on YouTube at least. So just as an appreciation for you guys sticking with us through all this technical difficulties, through all these changes that we go through until we get it right. All this is free. It'll be available for free. So Fed Barkins said all this stuff. Like I said, I did not hear not one of this stuff, but he did state that he does believe that inflation is coming down, but it will take more time. He also states that, oh, that's the same thing. He did say that inflation is coming down, but they are on the right path. Jobless claims are at historic lows, but they may be edging back up. But the overall labor market, the numbers are normalizing, and that the edge has to come off of demand to hit that 2% inflation. So, I mean, apparently he said all this stuff. We didn't hear it. Yeah, so this is going to be tough. This is definitely going to be tough. Obviously, I don't have the best entry. Obviously, I do not have the best entry. I believe that if price does come back, I may have to scale back into this again, possibly here at this 45 level. Hopefully, it does not come to that. However, on the higher time frame, price is still riding that 21 EMA train. It is still riding it. Hmm. Hmm. Yeah, that is true, Alfred. That is true. I feel like that's the universe's way to make sure if you want it or not. At least that's how I try to see it in a positive light. It's if you really want it, then you'll get past all these trials and tribulations. And they have definitely been trials. Definitely. So, like I said, man, we'll just keep this. I mean, y'all benefit from it. Definitely benefit from it. Uh, yeah. Let's look at see what the NQ is doing. I mean, the NQ, we had this breaker structure. They may come back here at this 750 level, or they may continue to push it down. Honestly, I don't know if it's because now I'm adjusted to trading the ES more than the NQ, which is crazy to even say. But I feel like the ES is moving more than the NQ moves. Not in the sense of, like, obviously NQ has moves like this and that's normal. And we're not talking about like that. But we're talking in a sense of I feel like the ES is moving a lot more. Like the moves are stronger than the ES or the NQ because, like I said yesterday, the ES before the session closed took out its all-time highs. They took it out before the session ended. The NQ didn't get that. The NQ did not get a retest of its highs until the next session. Yeah, if this is real, if the bears are definitely going to have to defend this level. But what I should do is actually reduce a lot of my risk. Put this. 245. All right, so let's see. This actually might get to 46 at the same time. I mean, hmm. Okay, but we'll see. We'll see if this is a head and shoulders pattern right here. This may be a head and shoulders. Maybe a head and shoulders pattern right here. Mm, 47, 47, 50. Yeah, right there. If it does get back up that high. Mm, okay. So the ES is definitely not. Let's see. I mean, this is taking out his high. That's not nothing new. So it seems like the NQ is trying to take this out. Yeah, I'm starting to think that's probably no. It can't trade above that high. It can't trade above that high right there. So the bulls are definitely going to have to break that. Well, at least on the ES, it has to break that 350 level with some authority. Which honestly, at this point, yeah, that's actually what they're gonna. It's probably what they're gonna do. Honestly. 340. You know, that would suck, man. That would suck. I'm not gonna lie, that would suck. That would suck, man. That would suck. That would suck. That would absolutely suck. Damn it. Mm. So it looks like it. It looks like the bears are going to be able to rotate price lower, at least for right now. I understand that bulls can get really regarded. I can understand that. But shoot, y'all don't want cheap prices? I mean, y'all don't want it cheap? I just want to keep buying high, buying high. All right, so let's look at this on the 4 hour actually. Actually, no, I don't want to do it on this chart. Damn. Damn. Jack, I don't know, man. I really don't. Like, man, I don't know. Like, this is really breaking my brain right now. Like, what the hell's going on? I mean, what's really breaking about it is because we know that the CPI is a lie. We know that inflation is not going down. And the reason why we know this is we can walk into our local grocery store and see that it's not going down. If the CPI is not artificially inflated, then the Fed would have more confidence. So, I mean, you just have to put those pieces to the puzzle together. I get that. I get that the CPI shows that inflation is slightly lowering in April. What I don't get is why this charade is still being held up. I mean, pull back. I mean, we can accept that the data was massaged. We can accept that, but there's a mega bull run up. Pull back. Shit. Pull back. Pull back. That's all I want is a pullback. That's it. Pull back. So I can buy into this. And that's the biggest, and that's another roadblock for me. I've already broken the habit of buying high. I've broken that habit, and it took me a long time breaking that habit. And I think that's something else that my mind is just unwilling to do. So the reason why I'm getting angry because these bears aren't following through is because I'm not going to buy it high. But if I'm not going to buy it high, I'm going to try to find a short opportunity. And none of these short opportunities are working the way that I think it should work because these bulls just keep buying it up as it goes down instead of just allowing it to go down and then buying it back up. But so it is a contradiction. I'm not going to buy this market high, but at the same time, these bears aren't following through. So rock and hard place. So yeah, we took out this high. So all the stops that was above this high right here at 709, we went about 51 points above this high. And usually when we get something like this, we get a sweep of the high, we get a decent pullback, we get a consolidation, and then we get a run up, a run back up. But now that we got a sweep of this high, it just seems that the bulls are just trying to just straight trade through it, not allowing price to pull back. They're just buying in, buying in, buying in. And that's usually a recipe for a rug pull. It's like crypto almost. It's almost like it's like the S&P now is trading like crypto. I guess it is a casino, baby, I guess. But so yeah, I can see it coming back to this high. That 612. We was talking about the 612 level this morning. I can see a pullback to 612. If the bulls doesn't allow price to come back this far, if our next news event is bad, I can see like a super crash possibly coming back and retesting this level. And then it being bought right back up. Because I know that there's bulls waiting here. I know at least at this high. Price may go even down further, but I know, or it's highly likely, that there's a lot of buyers sitting right here at this resistance that can possibly turn into support. So I know there's going to be a lot of buyers sitting right there. Look at the ES. Same thing with the ES, really. We traded above this high. The bulls won't allow price to get a decent pullback. They won't allow it to get a decent pullback. So any news drop is going to get immediately bought right back up. And I think, yeah, I do agree, but I think that 314 level is going to be that level where the bulls really come in at. And I might set a limit here pre-market at 314. May just set a limit right here. Yeah, Jack, I agree with that. I agree. I definitely agree with that. I definitely agree. Because if we're just going to shut up in color, I guess the market, or at least the sentiment of the market is CPI is good, PPI was good, even though it was revised, even though both CPI and PPI was revised. They were both good. And NVIDIA is next week on Wednesday, if I'm not mistaken. Yes, Wednesday. So the market can definitely continue to go up. But again, my plight is not with I don't care what the direction of the market is. It's just that the price action is just crap. I mean, if we get a dip, then I expect there to be buyers. If we get a push up higher, I expect there to be sellers. And that's just the cognitive dissonance. It's just there's a lack of rotation and the high probability of a rug pull. But the rug has not been pulled yet. Aladdin is still flying. Aladdin is still on his carpet, flying around. But I'll definitely be a buyer here at this level, though. All right. At this 305, 302 level, possibly this 298 level is probably, I'll be a buyer somewhere in here. If we can get down to this 15 level, 14 level, I'm pretty sure the bears or the bulls will definitely come in here. Yeah. Yeah, so it's the way that the price action is looking right now, it seems like the euphoria or the bull momentum is kind of dying down. I think the market has reached its objective by taking out the all-time highs, and the market doesn't know what to do right now. At least that's what the price action is suggesting, and this is why I'm saying it. I mean, we've taken out the all-time highs, and now we're starting to make lower lows or lower highs. We're starting to make lower highs now. And the bears are coming in. And the bulls are failing to push price higher. If we get a break below this low, then it's going to be official. We need a break below 338 on the ES for this bearish move down to be real. And the same thing on the NQ. We're starting to make lower lows or lower highs on the NQ. And that tells me that's a full rotation or that's a failed rotation higher. You can see that the bulls are trying to come right back in and trying to take it higher, and they're failing. I think the market objective was always trying to take out all-time highs. And now that it's taken it out, and you got CL pumping up. I mean, like I told Smith, I was sitting in a CL position all day, and that shit only moved up 18 cents. I was, I can't do that with CL anymore. I can't do that. She's starting to move like NG. Now she has her moves, obviously, but if you miss it, I mean, you really can't. What is today? Today's the 15th or the 16th. So today is the 16th. Let's illustrate this. And this is why I said, you know what? I just can't do this. I can't do this with her. So this is the 16th. To kind of illustrate. And so the market opened obviously at 5 o'clock right here. And it has a range. Just give or take 75. So let's do the math on that. So it seemed like it just made a dollar move today. Just about a dollar move. So yeah, so it moved up from top to bottom $1.55. So in order to maximize your profit here on CL today, you would have to caught this low at 5 o'clock in the morning, 5:30 in the morning, which this is a good area to go long. I can understand why the bulls found support here. It's a great area. It's a break. You can see how price broke out, and it's a retest of that breakout. So I can see why the bulls went long here. And this lasts until 8:30, and then we got this move down. I mean, the day is still young. I think we still got a couple more hours in the market today. But this slow movement, I can't deal with this crap. I can't deal with it. Hopefully in the summer months we'll get it to move again. But yeah, I can't deal with that. That's just too slow for me. But I'm gonna go to this meeting real quick. I'll leave it at the. And I absolutely hate that it missed my target. I absolutely hate that. I hate that. Mm. Mm. The structure is bullish. Yeah, I think we're just gonna play this game all day. And that would have been nice if that would have got filled. At 47, man, that would have been nice if that got filled. I mean, they may come back in that VWAP. Oh, they don't though. All right. But all right, guys. Honestly, I really don't even want to deal with this price action anymore. Let's see. I mean, I'll stream until 11 o'clock. But obviously, the market has definitely slowed down. I do believe that we have one more Fed speaker coming up. We have Mester speaking. Hmm. Hmm. We have one more Fed speaker speaking at 11. That's probably why the price action slowed down. And then we have Bostic speaking. Okay, so Economic Development Council briefings for business. especially on the ES. Okay, so I wonder how to do that. I wonder how. Because there is a way, or maybe let me see if I can look this up real quick because I did it by mistake, but I didn't know how I did it. The win key plus I. Two. Okay. You can install YouTube? That's cool. Okay. I gotta figure that out. All right, man. I mean, are the Bulls finally coming back, baby? Are the Bears finally coming back? Oh, crap. That might have been it. Oh, crap. That might have been it. Oh, crap. Crap, that might have been it. Yeah, this is going to probably be tough. Damn, this is going to be tough. This is going to be tough. This is going to be tough. This is going to be... Yeah, they might come back in right here. God damn it. And that's what I was talking about. That flash crash, and it gets immediately bought up because there's bears waiting right here. Or there's bulls waiting right here. I did say bulls. I'm a bull, man. It's just that I can't buy this high, man. I can't. I broke that habit a long time ago, and I can't buy this high. Even though it is working. Yeah. And they stopped right dead on VWAP too, so they might come back in. But what I will do though, oh man, this is it's not a good entry. That's why I would hate to move my stop to break even. I guess a good compromise is reducing my risk. Okay, I think that's how to do it. Okay. Okay, I think that's how to do it. Okay, that's how I did it the last time. All right, so now I know that for next time. I know that for next time. That's how you do that. Let's go, baby. Let's go. Let's go. Let's go. Drop this. Yeah, you know what? It may not even do it. It may not even do it. You got all this support, and then it bounced right here. Damn, it might not do it. All right.
Welcome. Let's hear it for Wayne County's diverse, dynamic, and driven
Oh
businesses
my
that were
God,
just
dude, with this
featured in
diversity
Made in
crap,
Wayne
man.
2.0. We
Okay.
always love the opportunity to tout and brag about all the cool stuff that's made in Wayne County. And we welcome you today. We're really excited to have this great turnout on a beautiful day when some of you could be on the golf course. So we're glad that you made your decision to come here instead. I'm Mary Beth Burns, the president of the Wayne Economic Development Council, and on behalf of our team, we say thank you for coming today. And thank you to President Mester for gracing us today with your comments. This is a B4B, a Briefings for Business, and the WEDC holds these quarterly. It's a great opportunity for the business community to get together and network and learn something about topics that are relevant to our business community. We appreciate your participation, and we welcome our guests from outside of Wayne County to Wayne County today and appreciate your attendance and partnership. We were really thrilled and excited. For the first time in my memory, our economic development partners locally have joined us for this B4B planning, and we appreciate their attendance and their participation. We're very excited and thrilled every day to get to work with such wonderful, talented economic developers. So I want to just take a brief minute to introduce those folks to you. First, Cameo Carey from Grow Ashland.
Yeah,
You
that's
can
like
give
I'm
a
not gonna
wave or
get
stand
that.
up. Mark Leninger from, there you are, Mark. It's nice to see you. From Holmes County Economic Development Council. Bethany Dentler from Medina County Economic Development Corporation. Hey, Bethany. I would be remiss if I didn't say Bethany has been awesome since day one in helping me in my role at WEDC. So I really appreciate Medina County and Kimberly as well. Kimberly Marshall from the city of Medina, very helpful. Appreciate that. And then lastly, Ray Hexamer, who's also been extremely helpful to WEDC from the Stark Economic Development Board. Thank you. I keep remembering that the last time I was up here for our annual meeting, my mother saw the photos and said, "You didn't smile once, you looked very grouchy." So I'm going to try to make myself smile every now and then. I believe we also have representatives from our regional partner, Team NEO. I don't quite know where you guys are sitting, but Sean, Kendra, and Abigail, there you are. Thanks for coming today. Appreciate that and appreciate all the support that you provide to our local economic development organizations. I am proud to be working among such talented people who are all dedicated to making great things happen in our respective communities. We also want to thank our event sponsors today. We appreciate the generous support from what we're calling our groundbreaking sponsors, Edward Jones and the 6 advisors from Edward Jones, Medina, and Wayne County. Thank you. And we thank you for bringing guests, one of which was a longtime coworker of mine, Larry Herman from Smuckers, years and years ago. It was so nice to see Larry. Hadn't seen you in, I don't know, 10 years. Can't wait to catch up. Cocktail after this, Larry. We also want to thank our sponsors of our events throughout the year, that MCTV, Magnet, and Ohio Means Jobs, Wayne County. And lastly, we want to thank the Wayne County Schools Career Center, LightSource BP, and Westfield Bank for sponsoring what Tracy has called our Sprouting Leaders tables, which I sometimes call just students, but Sprouting Leaders sounded way more creative. We appreciate the University of Akron students that are here. We've got some College of Worcester students and the Career Center students, and we really appreciate you being here. It's a great opportunity for you to mingle, and as you saw, we have great jobs available in Wayne County, so we want to keep your talented folks here.
Ah,
And
shit,
you
I just
folks
saw
from
it.
University of Akron
Shit.
are not allowed to leave the county.
Shit. Just saw
One
it.
housekeeping item, there are note cards on your table, and those are for you to jot down any questions that you might have for President Mester. Tracy and Caro will be collecting those, and we look forward to you asking whatever questions come to mind. Now it's my pleasure to welcome Eddie Steiner to introduce our keynote speaker. Eddie is a member of the WEDC board and executive committee. But equally important, he's also the president and CEO of the Commercial and Savings Bank and a director of the Federal Reserve Bank of Cleveland. Eddie was obviously very instrumental in getting our speaker secured today, and we appreciate Eddie's contribution with that. With no further ado, it's my pleasure to introduce Eddie Steiner.
It's not her, it's Mester.
Thank you, Mary Beth. And Steve
But
Matthews
she's a
was
Fed,
teasing
so
me,
yeah,
or
she can
Adam, one
definitely
of the
move
two,
it,
about being a
depending
stickler
on
for
what she
details.
says.
I'm going to be a stickler for details. At CSB Bancorp, the holding company, we own the Commercial and Savings Bank, and Brett Gallion is actually our president. I'm CEO, so stickler for details there, note to self.
Well, I mean, at least
But I will say,
in this
it is my
position, if it does
pleasure
hit my
and
stop,
my
we will
honor
end green.
to introduce our speaker, Loretta Mester, President and CEO of the Federal Reserve Bank of Cleveland. In her role, she participates in the formulation of U.S. monetary policy and oversees more than 1,000 employees at the bank in Cleveland, its headquarters, the district headquarters, and also Pittsburgh and Cincinnati. President Mester is a trained and practitioner economist, I would say. She has a PhD in economics from Princeton University. Besides her work on behalf of the Fed, she is active on many civic and nonprofit boards, and those include the Greater Cleveland Partnership, the Cleveland Orchestra, and the Cleveland Clinic. She is a frequent and sought-after voice on matters related to the economy and monetary policy, and many of you have likely seen her being interviewed on Bloomberg or CNBC or other national or global media on various occasions. While I have known President Mester for the full 10 years since she arrived, I was on an advisory council at the time she came, I have had the privilege since 2019 of seeing her in continuous action as a member of the board at the Federal Reserve Bank of Cleveland. And I want you to know that in my business career, I have yet to interact with any other individual more genuinely interested and wholly, constantly engaged
Bro, you can get
in
off your knees, bro.
understanding the dynamics at
Get off
play,
your knees, bro. It's not that serious.
affecting the economy as a whole, but beyond that, the economic well-being of individuals, households, businesses, and organizations. She just doesn't quit. It's an intellectual curiosity driven by something that just makes her engage, and that is one of her outstanding features. You will find President Mester is a very engaging conversationalist. She likes questions. There's going to be a Q&A afterwards. She really does. So I would encourage you to be listening closely to what she said, and also not just from her prepared remarks, but to ask what's on your mind. I am confident you will find that her insights and perspectives are meaningful to you, to organizations that you're representing, both her prepared remarks and when we ask her the questions later on. But please join me in a warm welcome for President Loretta Mester.
Oh, give me a second, guys. Give me a second, I forgot.
Well, thank you, Eddie, for that. That was very nice. And also thank the Wayne Economic Development Council for inviting me to speak on the economy and monetary policy in this Briefings for Business series. You know, when I think about what your council's work is about, it's to foster economic development in the region. And that really aligns very well with the Federal Reserve's mission to foster a strong economy. So I'm particularly happy to be here today. Now, as you know, Eddie Steiner is an active member of our board of directors. He's also the chair of our board's audit committee, and as he says, you know, this is important work that we do on behalf of the country, and we couldn't do it without board members like Eddie Steiner. So I really appreciate that. Steve Matthews is going to be moderating the Q&A portion of today's session. And he is an active member of our Northeast Ohio Business Advisory Council. And I really want to take the opportunity to thank both Steve and Eddie for all their contributions that they're making on behalf of our bank. We could not fulfill our mission without their help. And I also want to thank the many others in this room. You know, you all regularly provide us with economic information that's really crucial to our understanding of what's happening in the economy. And if you look at the Beige Book, which is the publication that the Federal Reserve publishes a couple of weeks before each Monetary Policy Committee meeting, you'll find that, you know, we summarize the information we've gleaned from our district in that book. And that really helps us understand what's going on in businesses, the labor market, communities, and financial markets. And it really is really important information. You know, we do get a lot of data. Everyone can gather economic data. The government puts out statistics. We gather our own data as well and some of our own surveys. But a lot of times that data tells you about where the economy is or where it's been. The information that we're getting from all our contacts throughout the district really tell us about a good idea of where the economy is going. It really helps us discern the future a little bit about where the economy, how it's evolving. So that's really important for monetary policy making. So the people who are providing us with information, and I want to thank the many people in this room and who are listening in for doing that work for us, you are playing an important role in the making of monetary policy. It really helps inform my own views about where the economy is going, the outlook for the economy, and what I should be doing as a monetary policymaker. And I bring that information with me to FOMC meetings, and I share it with other policymakers so they also can understand what we're seeing here in our region of the economy. So thank you very much for that. I really do appreciate that effort because you're all very busy in your own companies and your own businesses and your own communities, but you're doing this on behalf of the public, and I really appreciate that. So as Eddie said, I'm really looking forward to the Q&A portion of this speaking engagement. I really learn a lot from what I hear on people's minds. It does help inform my views on the economy. So I really do hope that you'll use the cards on your table to put in some questions, and I'll do my best to try to answer them and give you my views on those topics. But before we get into that portion and that dialogue, I thought it would be really helpful to frame the discussion by offering some remarks about the economy and monetary policy. And I must say, the views I present today will be my own and not necessarily those of the Federal Reserve System or my colleagues on the Federal Open Market Committee. So the FOMC met about 2 weeks ago, and at that meeting, the committee decided to maintain the target range for the federal funds rate, which is our policy rate, at 5.25% to 5.5%, and to continue to reduce the Federal Reserve security holdings. And we've held our policy rate at that restricted level since July of last year. Now, the FOMC reiterated that it doesn't expect it will be appropriate to reduce the target range until the committee has gained greater confidence that inflation is moving sustainably toward our goal of 2%. Now, if you step back, substantial progress has been made on the inflation front since inflation peaked in 2022. And remember, it peaked in a range of 7 to 9%, depending on the measure that one looked at. In the second half of last year, inflation readings came in lower than expected, and PCE inflation was running at about 2%, or at our 2% goal over those 6 months of the year.
Damn.
But the year-over-year measures of inflation remain elevated. And we on the FOMC knew it was too soon to declare victory over inflation. Now, over the first 3 months of this year,
This might be a double bottom, guys.
we have seen no
This might be a
further
double bottom if you're in
progress
this
on
short.
PCE inflation. In fact,
This might be a double bottom.
measured year-over-year headline PCE inflation moved up to 2.7% in March, and core PCE inflation remained at 2.8%. And if you look at the 3-month changes, they're running considerably above the levels seen over the second half of last year. Over the past 3 months, PCE inflation in core goods and PCE inflation in core services, excluding housing, have moved up, and housing services inflation has moved sideways. Now, we did get a CPI inflation report yesterday. That's the first inflation report we have for the month of April. And we saw a welcome tick down in the monthly readings for total and core CPI inflation. But those readings were higher than those we saw in the second half of last year.
Yeah, keep saying shit like that, baby.
Now, I had expected the progress on inflation to slow this year compared to last year, because I didn't think we'd get as much help from the supply side adjustments that we got last year. Supply chain disruptions and bottlenecks have really improved over the past 3 years, and the labor market has been normalizing. So people have returned to the labor force over time, and immigration has also increased the supply of labor. So that healing of the supply side of the economy contributed to last year's disinflation, and I don't think we're likely to get as much help on inflation from the supply side this year as we saw last year. Progress will depend more on moderating demand. Still, the lack of progress on inflation so far this year has been disappointing. I do think it's too early to conclude that progress on inflation has stalled out or that inflation is poised to reverse course. You know, we knew that the journey back to price stability was never going to follow a smooth path, but the recent readings have not inspired greater confidence in me, and we're going to just need to accumulate further data over the coming months to have a clearer picture of the inflation outlook. I now believe it's going to take longer to reach our 2% goal than I had previously thought, but, and I want to say this very emphatically, the Fed remains strongly committed to returning the economy to price stability. Now, the good news is that the economy is well positioned to allow us to accumulate those data without concern that monetary policy is overly restrictive. A really remarkable thing about last year's disinflation is that it occurred in the midst of strong economic growth and labor markets. Last year, the economy grew at a pace above 3%, which is higher than my 2% estimate of trend growth. And indicators point to continued upward underlying momentum in the economy this year. According to the advanced estimate, GDP growth did moderate to a 1.6% pace in the first quarter, but that step down reflected the inventory and trade components, and those components are often revised in subsequent releases as more data come in. If you look at final sales to private domestic purchases, so think about that's a pretty good indicator of underlying demand, that continued to rise at a pace of around 3%. So that's pretty good growth. Consumer spending has remained healthy, although we have seen rising credit card delinquencies. And business fixed investment in equipment and software has strengthened, which is consistent with the anecdotal evidence that we're getting from our business contacts. Indeed, leading up to the FOMC meeting 2 weeks ago, there was a significant change in tone from the contacts in our district. Many reported that economic activity had strengthened, and by more than they had anticipated over that period. Labor market conditions also remain strong. Payroll job growth really has been remarkably resilient. Job gains averaged about 270,000 per month in the first quarter of this year, compared to 210,000 per month in the previous quarter. Now, we did see a moderation in employment last month, but it's still a healthy gain of 175,000 last month. The unemployment rate remains low. It's 3.9% as of April. And even with those strong numbers, we have seen some better balance coming into the labor market. You know, demand for workers has moderated, supply of workers has increased. And the gap between the number of open jobs and the number of unemployed workers has narrowed over time. In fact, it's now about 1.3, so 1.3 jobs per unemployed. And that's only slightly above the 1.2 level that we saw in 2019, which was also another period of strong labor market conditions. And when you talk to regional contacts, they tell us that it does remain difficult to find candidates with the skills needed for certain jobs, But in general, they also tell us that it has become easier to hire over time, and that's that moderation that we're looking for. Now, as labor demand has come into better balance with labor supply, wage pressures have eased. So firms in our district, right, are now expecting wage increases to average about 4% this year, but last year they were expecting them to be 5%. So that's a moderation. And if you look at the wage premium, right, what can you get from switching jobs compared to staying in your job, in your current job? That's moved back down to levels that are about where they were pre-pandemic. So another sign that there's been some, better balance in the labor market. That level had shot up during the pandemic and right after the pandemic when the labor markets were open again, the economy was open again, and people were really being bid away from their current jobs because firms just really needed to have workers. Now, the question always comes up like, well, is that wage growth inflationary or not? And, whether wage growth adds to price pressures depends on whether wages are adjusted for inflation, so real wages, are growing faster than the growth in labor productivity. Now, if you look at current estimates of trend productivity growth, right, they're in the 1 to 1.5% range. So wage growth is still above the level consistent with 2% inflation at that level of trend productivity growth. But there is a possibility that changes in technology are going to lead to higher trend productivity growth. If you think about the scarcity of workers during the pandemic, we heard from many, many firms that, they had this great incentive to automate and they were doing so. And then there's new technologies such as generative AI. I mean, they do hold the promise of increasing productivity over the medium to longer run. So if it's true that there's going to be higher productivity growth and that those high numbers that we got last year, if they're sustained, then it could be that current levels of wage growth could continue without adding to price pressures. However, if the estimates of productivity growth that we've had over time, the 1 to 1.5, then we'll still need to see some moderation in wage growth. Now, when you think about our regional economy, the current developments in activity, employment, and inflation at the national level, we're also seeing them in Ohio's economy. And, as in the nation, labor market conditions in the state remain strong, but we have seen signs of them moderating, which is a good thing. The state's unemployment rate has ticked up this year, but it stands at 3.8% in March, and that just is it's near its historical low, so that's a strong indicator. Employment growth over the first 3 months of the year has slowed from last year's strong pace, and that's another sign of moderation, still healthy but moderating. And as I mentioned, employers in the state are telling us that it's now easier to hire than it was. Now, immigration has likely helped ease some of that labor market tightness. Last year, immigration was the main driver of an increase in Ohio's population, which was the first yearly rise in population since the pandemic. So all in all, we have seen strong labor market performance in the state, just as we've seen it at the national level. Now, Ohio is the 7th largest economy in the nation in terms of gross state product. Manufacturing and within manufacturing, auto and auto parts constitute an important sector of Ohio's economy. And compared to the nation, manufacturing still represents a larger share of payroll jobs in Ohio. But if you look over time, that differential has fallen as the economy here is diversified from one largely dependent on manufacturing and heavy industry to one in which healthcare and education play a more significant role. So if you think back to the 1990s, manufacturing represented about 20% of Ohio's jobs, and eds and meds represented about 12%. Those shares have now basically reversed. In the past decade, the share of jobs in manufacturing has fallen to under 13%, and the share in eds and meds has risen to nearly 17%. So we see this transformation over time in our economy. Now, the good thing is that regions that have diversified their industrial base have generally fared better over time and have proven to be more resilient. When a shock hits the economy, they've been able to bounce back better than other regions that are more heavily in one industry or another. But of course, the type of shock that hits the economy matters for that. right? It can, that type of shock can have differential impacts on regions depending on what their industrial mix looks like. So, for example, if you think back to the pandemic, healthcare was hit particularly hard. And the labor market in healthcare remains particularly tight, with nurses expected to remain in short supply for some time to come. But the good news here is that even within healthcare, our contacts are reporting to us that they have seen some improvement in hiring and some normalizing in wage growth. So again, the trends we're seeing in the nation are being seen in our own regional economy as well. So what about the outlook? So in my view, the most likely scenario for the overall economy is that, and that of our region as well, is that the current restrictive stance of monetary policy will continue to help moderate growth in labor market conditions, and this moderation will contribute to further easing of price pressures. So I do expect progress on inflation over time, but at a slower pace than we saw last year. And there's some research that supports that view. Analysis at the Cleveland Fed indicates that if you look at the past slowdown in wage growth that we've seen, that's going to pass through to lower price inflation in core services, and that the declines that have occurred in rents in new leases will pass through to slower inflation in housing services. But both of those effects are going to be needed for us to get back to 2% inflation, and both of those effects will take some time. So setting monetary policy in this environment is going to take careful consideration of the risks to both parts of our dual mandate as the economy evolves. And our dual mandate, of course, is maximum employment and price stability. So recent data showing strong growth and labor market indicators suggest that risks to the employment part of our mandate have diminished. But the recent inflation readings suggest that risks to the inflation part of our mandate have risen. So I'm going to be particularly attuned to the upside risk to inflation. And there are a couple of them. Geopolitical tensions have the potential to further raise oil prices and other commodity prices or to disrupt supply chains. The shortage of housing could keep housing services inflation elevated, even though rents have been falling. Medium and longer term inflation expectations are important determinants of actual inflation, and those expectations have remained reasonably well anchored at levels consistent with our 2% inflation goal throughout the high inflation episode. So that was a benefit because that anchoring was really an important contributor to the disinflation we've seen over time. But if you look at the recent readings, at least on short-term inflation expectations, they've moved up again as the inflation readings have moved up. And if that increase in short-term expectation were to spread to medium and longer-term expectations, it would be considerably harder to reach our goal of 2%. So setting monetary policy to ensure that those expectations remain well anchored will be very important. So the FOMC's job continues to be to assess the implications of economic and financial developments for the outlook and the risks around the outlook, and given that assessment, to calibrate monetary policy so that inflation returns sustainably to our 2% goal and labor markets remain healthy. Now, the actual path monetary policy takes will depend on how the economy actually evolves. And this is that data dependence that policymakers often refer to. But our current policy stance puts us in a really good position for managing the risks that could be realized. In my view, moving rates down too soon or too quickly without sufficient evidence to give us confidence that inflation is on a sustainable and timely path back to 2%, we risk undoing the progress we have made on inflation. And with labor markets and economic growth both being very solid, we don't need to take that risk. Incoming economic information indicates that it's going to take longer to gain that confidence. So holding our restrictive stance for longer is prudent at this point as we gain clarity about the path of inflation. Now, once the FOMC does gain confidence that inflation is moving sustainably back to 2%, it will be in a position to begin to gradually normalize policy back to a neutral level as the economy returns to price stability and maximum employment. Now, it's not my base case, and I want to emphasize this, it's not my base case, but should developments in inflation and inflation expectations warrant it, policymakers will need to be open to tightening policy further. On the other hand, If the labor market unexpectedly deteriorates, again, not my base case, but in that case, policy could ease sooner and by more than currently anticipated. So monetary policy is really well positioned for risk management as we gather more evidence on how the economy is evolving. So the FOMC remains fully committed to returning inflation to our 2% goal because price stability is critical for the long-run health of the labor market, the overall economy, and the stability of the financial system. And as we've seen since the pandemic, high inflation can badly affect people's lives and their view of the country's economic well-being. So at a recent Business Advisory Council meeting that Steve participated in fact, I think he led this discussion, we discussed the fact that even though the labor market is strong and inflation is down from its peak, many people are not very happy about the economy. And if you look at measures of consumer sentiment and consumer confidence, they're well below their pre-pandemic levels. So I believe dissatisfaction with the economy partly reflects the fact that even though inflation has been coming down and wage gains have been relatively high for some people, prices for many things are still higher than they were before the pandemic, and many people's wages haven't really kept up with inflation. So when inflation persists at levels above our goal of price stability, the price level, that overall price level in the economy, is moving up faster than we'd like, and households and businesses have to pay those higher than desired prices. Now, the good news is that as inflation has been moving down, wages adjusted for inflation, real wages, have begun to move up. And as that disinflation process continues, it's going to help close the gap between the cumulative increases in prices that we've seen over this period and the cumulative increase in wages. So as that gap closes, I think people will then begin to feel that they've made up for lost ground. Now, the other factor I think people, why people aren't that happy with the economy is that it's much harder to purchase a house than it used to be. So the median price of a home in the US is now almost 50% higher than it was prior to the pandemic. If you look at the 30-year mortgage rate, they're now over 7%. Prior to the pandemic, they were under 4%. And if you look at a recent study of consumers that the New York Fed fielded, they found that renters believe that the probability of ever owning a house, is now falling to 40%. And that's the lowest level since the question was first asked in 2015. And as everybody in this room knows, owning a house is really an important avenue for building wealth. But many people feel this part of the American dream is out of reach, at least for now. And that's just not a good feeling. So I'm hopeful, though, that the economy will evolve as expected. And as inflation returns to our target, we return to price stability. As economic conditions continue to normalize and as the labor market remains healthy throughout, then more people will be able to enjoy the benefits of what a strong U.S. economy has to offer. So thank you for listening. That concludes my prepared remarks, and I'm really looking forward to our discussion. Thanks.
All right, here comes the games. I wonder if this is going to get pumped right back up to 345.
Well, Loretta, thank you for taking time for a Q&A. I want to let everybody in the room know that when Loretta was appointed to lead the 4th District, we literally hit the jackpot. And to reinforce what Eddie says, extraordinarily thoughtful. I leave a meeting with Loretta and her staff, and I just think, regardless of all the noise and the news and whatnot, we have steady leadership, and I thank you for that. So I know there'll be a lot of good questions because we have a thoughtful crowd here today. So I'm looking forward to the questions. Mike will gather the questions and bring them up. So we'll start. And by the way, when I see Loretta on CNBC or in the news at all, I admit that I'm a fanboy. So.
Thanks. I need.
Yeah. Okay. Question number 1. In your speech, you talked about information that your business contacts have provided you. Can you tell us more about how you collect that information and how you relay it to other Fed officials when you meet in Washington?
Okay, good question. So The Cleveland Fed, I think, does an excellent job of gathering this information. And we do it in a number of ways. We have 8 business advisory councils, and they're across the district. So our district is all of Ohio. It's part of Kentucky. It's part of Pennsylvania, and it's part of West Virginia. So we're trying to really gather information from the complete district. And as I said, a lot of that information finds its way into the Beige Book, which is that publication that kind of looks at the regional economies before every FOMC meeting. In addition, we have a community advisory council. So that council really helps us understand what's happening at the grassroots level in communities in our district. We have a CDAC, which is a community depository, and Eddie was on that, Depository Institution Advisory Council. And so that's another way we gain information, because banks are really a good source of information. You know, we have bankers on our board. By statute, we have to have bankers on our board, but they're really a good conduit of what's really happening because they're really in touch with their customers. We also have a Diversity and Inclusion Advisory Council, which helps us understand some of those issues that are affecting our district and businesses and hiring. So there's just a lot of information that we gather through these touch points that we have throughout the district. We have an Energy Advisory Council, I guess we're calling it a roundtable, where we're really trying to understand what's happening in the energy sector, which is important for parts of our district. So again, we do that in person kind of talking, whether it's in person or online, but it's interacting with individuals. Then we field a number of surveys, and a lot of people in this room, I'm sure someone in your firm is filling out a survey for us. And that information is great because what happens is our research staff take the answers and they develop what we call diffusion indices. And the kinds of questions are, has activity increased over the past 6 weeks or decreased? And then we can sort of analyze, well, what % of our respondents are seeing increases versus decreases? And those kind of diffusion indices actually are informative about the future. So there's a number of touch points. I like going out and talking to people in these kind of venues too, because I learn a lot from the questions about what I should be focusing in on. Oh, I hadn't really thought of that as being a big issue. Now I have to think about that a little bit. So there's a whole bunch of avenues that we try to make sure that we're really in touch with what's going on the ground. Because one of the things I said in this speech is really true. That information is really forward-looking for us, and that's really important. And then when I go to FOMC meetings, you know, we all sit around the table and talk about the economy. I always make a point. I structure my comments, and you can go, I think some of mine now are public for FOMC transcripts. I always structure by first talking about the district economy. What am I seeing in the district? Then I say, okay, and here's how I'm viewing the national economy, and I try to relate the two. And then I talk about policy in part of the meeting as well. So I'm trying to make sure that I'm a good representative of the 4th District at that table. And that information is actually important for setting monetary policy.
Yeah, and I would say that Loretta and her entire staff, they don't just hear us, they actually listen, and there is a difference. And I've never left a meeting that I didn't feel that there was a lot of thoughtful listening going on. And I know that we're well represented, so thank you for that. Question 2. Will the increased onshoring of manufacturing and the subsequent increase in manufacturing jobs add additional inflationary pressure?
Well, I think those things happen over time. So I'm not concerned about that as being inflationary in the current environment. I think that kind of onshoring is part of the economic environment in which monetary policy has to take account. Right? But it's not like a near-term risk to the inflation outlook at this particular time. I do think, you know, there's a whole interesting thing going on in terms of underlying structure in the economy, whether it be supply chain issues that we faced, people feeling that they need to make their supply chains more resilient. There's, you know, national defense reasons where you might want to encourage more manufacturing to be onshored versus offshore. And then there's also the infrastructure spending. When all those things happen, they're important parts of the economic environment that will feed into what your outlook is for the economy. Some are longer term issues that we're going to have to think about. Some are shorter run issues. But the onshoring as per se is not something that in the current inflationary environment is one of the factors that's a main driver.
Next question. What do you think the impact will be from the latest imposed tariffs by the current administration?
But again, I think of this as being something that, the Fed, as monetary policymakers, we take into account what's happening on the fiscal side of the economy, what's happening on other policy.
Economic future. Well, that's a loaded question.
Okay. All right. So there's a lot of work going on within the Fed to understand the issues that are posed by an alternative payment system that doesn't run through or store wealth, whatever you think crypto is, because different people have different views about it, versus a national currency. And so there is work going on in the Fed to understand the implications for the transmission of monetary policy, for payments, for other aspects in terms of bank regulation, financial stability. No decision has been made about a central bank digital currency or anything like that, but we're doing work to sort of understand those issues. And we're also doing work to understand the technologies, because some of the distributed ledger technologies are going to be useful for the Fed payments as well, not just for cryptocurrency payments. So there is a lot of work going on, but there's no decision being made about central bank digital currencies. And we wouldn't make a decision, the Fed wouldn't make a decision without it being sort of vetted in Congress, and Congress telling us that this is something that we wanted to do in the administration as well. So.
Thank goodness, because I can't even spell cryptocurrency. That's good.
That's a damn shame.
With our national
That's
debt
a damn
growing
shame.
at a rapid pace,
It's not that hard.
nearly $1 trillion every 100 days, should we be
That's-
fearful of what awaits us in the next 10 to 20 years?
I do think that it's important for the country to get fiscal situation on a sustainable path. I don't believe it's on a sustainable path now, and there'll have to be work that is done to sort of balance things, right? So it's probably going to be a combination of taxes, spending, revenue growth. But I think eventually we're going to need to actually take that seriously and get it on a sustainable path. Is it an immediate issue right now? No, because we have Treasury securities that are very much in demand across the world. But I think for the health of the country, we need to get that on a sustainable path going forward.
This is an election year.
Is it?
How did you believe that? It's unbelievable. I wouldn't have known. How does the Fed navigate this period when it moves might be seen as when the election might be seen as influencing the outcome in November, or when the moves of the Fed might influence the outcome?
Yeah. So I get this question a lot, and I can tell you, I've been going to FOMC meetings since 2000, because I was a research director and I got to go to FOMC meetings when I was a research director. And I honestly can tell you that politics does not enter that room at all, right? We don't talk about it. We don't discuss it. We really are focused on what's the best monetary policy to achieve our dual mandate goals of maximum employment and price stability. We try to live up to that every day. And I think the integrity of the Fed is really what protects us, by always trying to be objective, good actors in terms of making sure that we explain our policies, explain why we make the decisions we make. That's why I think central bank communications are really important, because we have to live up to the trust that the American people puts in us. But I honestly, that doesn't come into the room.
Thank you. As electric vehicles become ever larger percentage of the national fleet, how might the corresponding decline in petroleum consumption impact the U.S. economy and employment?
So it's a good question. But I think of it a little bit differently in terms of, right, there's going to be opportunities. And whenever there's been a shift in technology, and I think of this as almost like a shift in technology, right, there's opportunities, right? So it's going to take a long time for that transition to happen. I think some people thought it would happen quicker than when you actually look at the data that says, well, we're not going to transition as quickly as we might have thought. But those transitions are true about a lot of industries that might have been the industry to be in, and then another industry, rises up. I mean, you can think about over time when that happens. This is another opportunity, the way I look at it.
Yeah. Good. So this comes from Team Neo, our friends at Team Neo. What strategies can Northeast Ohio implement to address demographic challenges coming to a head? Stagnant, decreasing population, and aging population. That's a big question.
Well, I was looking at these population statistics because, of course, we know that immigration was higher than people had anticipated it being over the last couple of years. And it is true, like in Ohio, we are aging. Natural births and deaths, right, last year were still not a contributor to growth. It was really mainly immigration and a little bit of domestic migration to the state. So that isn't a challenge because we know that, you know, regions' health, right, depend on having a vibrant labor force, having more people join. I think one of the big important things, and I do believe it's going on, is keeping the students who are here in the region, right? We have great universities in Ohio, very good universities. They attract people not only from Ohio, but outside of the state. We should keep those great minds here in Ohio. And if we can do that, right, and we can train the people who are from Ohio to get the skill sets that are necessary to do the jobs that are being attracted to Ohio, then I think we have a real chance. But we do need to take some effort to actually do that work. And there's a lot of work going on between businesses now and community colleges and other universities to try to do that work. And I think that's crucially important.
And I would just add that business owners and CEOs should really actively look at internship programs and things to really attract these kids and give them an opportunity. I would encourage everybody to do that. Not that you're here to listen to my answer, but to what extent do the central bankers of other nations typically coordinate with the Federal Reserve in terms of setting interest rates, or are the decisions completely independent and just inform each other?
Yeah, there isn't coordination. There is sharing of information and sharing of information to sort of understand what's going on in the world economy, the global economy, because that does affect the U.S. And of course, they want to know what's happening in our economy because we're a large global economy. So what happens in the U.S. does affect the rest of the world. But there isn't coordination per se. There's not Jay Powell doesn't talk to, you know, the chair of the ECB, you know, and say, okay, I'm going to raise interest rates here, or Andrew, you know, the UK, and say, I'm going to, you know, that doesn't happen. But there is communication because it's better for everyone to sort of understand what's going on in the global economy.
We have time for just two more questions, so we'll get these out there. And one's really a good question. I'll save it for last. How can the Federal Reserve and local government work together in addressing future development in housing?
It's a great question because one of the things that we've seen during this cycle, but it predates this cycle, is there's a real lack of supply of housing. And there's a lack of supply at all income level housing, right? You know, there's affordable housing is not there, but even on up, there's this lack of supply of housing. And of course, housing is incredibly important, right? You know, we have the Intel plant coming, like, do we have the workforce? That's the first question he asked. Do we have places for people to live if we're going to attract these people to the region? So that's an incredibly important thing. I mean, we're doing some work at the Fed to really understand what's happening in the housing market. Our community development staff, we have some experts in housing, and they do things in terms of, we don't collaborate, I would say, with government, but what we do at the Fed is put out objective research that has policy relevance. So for example, we've investigated the zoning issue and sort of understanding whether zoning rules are contributing to some of the issues in the housing market. We understand sort of what's happening on the inflation side, which can prevent, you know, construction from going forward. So that's kind of what our role is at the Fed, is really providing that objective analysis that other people can use in their policy-making role.
Great, thank you. And we have time for one more question. You mentioned that the majority of Ohio industries has transitioned away from manufacturing and toward ed and med. Why do you believe this is the case, and where do you see the manufacturing industry headed?
So I do want to point out one thing, that, you know, the data that we have on those shares, it's employment shares. So as manufacturing has changed,
yeah, this is actually definitely
right,
get back up
from heavy manufacturing to more, I would say, technical manufacturing or different kinds of manufacturing, right? You don't need as many people. It's more productive, right? So it doesn't mean that it's a less important part of the economy in Ohio, but when you're thinking about labor markets, you do have to recognize that where are the jobs going to be? And we've seen this transition. Service, 4250. And this is true in most states, right? We've seen a movement from manufacturing and heavy manufacturing in particular to service sector. And that takes different skill sets. It takes different kind of talent. It takes different kind of, it results in different kinds of income growth. And so I think it's something that everyone should recognize that that's going on. But that doesn't mean that manufacturing isn't going to be an important part of the Ohio economy. In fact, regions that have that diversity, right, actually fare much better. And there's a whole body of research that looks at that they're much more resilient, because we don't know what shocks are going to hit us. I didn't anticipate a pandemic, I'll admit that. But, you know, we had it, and we don't know what the next shock will be. But if you have a diverse economy, you're going to fare better. And so some of what I was trying to say there is we have seen some more diversification, and I think that's good for the region.
Well, thank you, Loretta. That concludes the Q&A. Let's give Loretta a great Wayne County round of applause.
Okay, that's okay.
Well, thank you very much. That was an insightful B for B, and we appreciate your time.
All right, guys. That is it. Great stream today. Obviously, we did make money today, but we definitely could have made more here at this retest. I did look at this morning. I did look at this. The reason why I didn't want to take it is because we're just so high up. I didn't want to get caught in a rug pull, not a rug pull, but for price to find a better entry. What I will say is that if price gets into this area right here, this 315 area, I would definitely be looking to be a buyer here at this level. And also, if price gets down to this 300, 298-ish level, I'll be a buyer. But this, on a regular basis, that is not ever going to be a good trade. But it did work out today, so it did work out today. Yeah, it definitely worked out today. This was obviously the trade. 329. Yeah, this was a 20-point trade. 20 points. But all right, guys, appreciate you joining. We'll do this again tomorrow. Peace out.